Okay, hello everyone. I hope I am live. And yeah, we are live. I think yes, you can hear me. Yeah, I think I'm audible and visible. So yeah. Hello students. I welcome you all for the third class of the YouTube revision series, which is about our favorite subject, that is SBR. So guys, if you have not even watched the first and the second class, do watch it, because in the initial classes we have learned about how are we going to go ahead with the examination, like what should be the my ideal way to study, right? What are the things which I need to prepare it, and for sure I need to prepare it cool, because if I just don't consider that portion, then definitely my complete syllabus will not be over. By then, we have understood that in our course of 5 days action, we are going to understand the most 5 important standards and obviously 2 mock papers too. So, we have already covered up IFRS 15, IFRS 16, and consolidation I have covered it prior to like in September 2023. So yeah, students, we can watch that. And in the yesterday's session, I have started with IS 19, so just carrying forward with the same. So let's begin. Just give me 1 minute. Yeah, because I just need to confirm it. Yeah, cool. Okay, I think we are live. I'm just wondering it for that. And I really want us to like solve a lot of papers. Okay, students, please, I'm
Just
request.
give me 1 minute.
Yeah, it's perfect. Yeah, live. Yeah. Okay, yeah, we are live. Okay, students, I really want you guys to practice the papers in the CBE platform. Okay, now if I'm going to give you some tips and tricks for the IS 19, so the best tips over here, the tips and tricks which are really very important is this IS 19. I know it's something which is not there in the FR syllabus, so people might find this difficult. But if in International Accounting Standard 19, I bet you, if you go ahead with the accounting theories and that too basically with the accounting entries, like it will be the most easiest standard. Trust me, it is the most easiest standard only and only if you know how to account it for theory. So before I go ahead into the syllabus, into the course of this chapter, I would like to show you, I would like to give you one very easy way. So, what are we going to understand for the first? And in this chapter, people will consider, okay, ma'am, this is very difficult chapter. This is very difficult standard. Why? Because students misses out the terminology. What's terminology? Certain terms, they would miss it out. So like what are the certain terms that students may miss out? So I'll just brief you out some terms which we feel, ma'am, it's very difficult, it's very weird, like we have not seen in other standards. But the meaning, see, whatever the words are, I know it has only two places to come in. Yeah, students, this is the most important thing which I'm saying you. Yeah, it is the most important thing. The best, the best. Yeah, I'll just say you, it's the best important tips and tricks that we need to know when we are doing any standard. See, whatever the standard is, guys, whatever the standard it is, it has only two positions to come up. Legitly, it can be either the P&L account or it can be either the financial position. Yeah, we know inside the financial position, equity portion comes into it, but whatever it is, we just have 2 pages. It's just like a two thing which has to come up, and it's our responsibility, understanding SBR, being an ACCA, we have to post it very properly. So yes, students, with this overview, we are going to understand the important terminologies of IS 19. Okay, so let's begin with the important words which we need to know in IS 19. That is basically the employee benefit. Yeah, some of the words in the previous class also I have heard it. You'll be saying, yeah, ma'am, we know. But yeah, why not? First, if in the current year, if I have some expenditure, forget about it. If I have some expenditure, so I'll be booking some expenses. So that expenses are known as employee benefit expenses. To whatever it is, may be payable. Yeah, that is very easy. But we have some different terminologies which were bifurcated into, yeah, if you remember, post-employment benefit. Yes, in post-employment benefit, we have two words which are again important, students, which terms around to be, yes, DCP, DBP. What's that? What's that? Defined contribution plan and defined benefit plan. See, the word is same. It's basically defined and some plan. Over here also it's defined and some plan. But the things are, over here we need to contribute it, and over here we need to have a benefits. So yeah, in the previous class, in the previous session, I have explained you guys, when it's contribution now, the employer will be relieved. It means employer did the contribution, employer is done. I don't want to do anything. It's just like, okay, I have like contributed things and I'm done. To whom? For example, the PF department, if I have contributed it, I am not responsible till the end. Whenever the employee comes and asks me, ma'am, please give us the PF that you have deducted, I will say, see, I have deducted from your salary for sure, but I have already contributed it to the department. You can go and ask the department, they will help you out. Okay. So my responsibility gets relieved. But when it comes to DBP, which I told you becomes very important from the exam perspective, also from the exam perspective, like I am so pretty sure if the examination, if the examiner asks you about IS 19, it can be a concept from this DBP only, defined benefit plan, because this DBP in itself is a very big thing. Yeah, in itself it's a very big thing. So yeah, what's DBP? I'll insert one more page so that we'll understand it very beautifully. The DBP terminologies. So what's that? Defined benefit plan. So in the previous session I have also explained you that over here it's a defined benefit plan means, for example, that gratuity one. Yeah, you remember? So I told you, okay, the employer has promised that those employees who stays in my company for 5 years will be given the gratuity at the rate of so and so percentage. Plus they'll be given on the salary, which is like incremental basis. So yeah, there could be some increment, etc, etc. So gratuity, if I'm going to pay after 5 years, ma'am, we'll book the expense also after 5 years. But yeah, that is not a scenario, we know. If the expenditure are paid after 5 years, but the employee has rendered me services on and on and on, I am supposed to book the expenditure for every year. Yeah, that is something which we have already studied. So in defined benefit plan, we have come across some two words, if you remember. Yeah, current service cost. Yeah, some cost which I have to incur it. It's like a P&L expenditure. I had explained you. Like if it's a defined benefit plan, like if I'm getting married after 5 years, so what I'll do, somewhere I know it's an expenditure I have to do, but to secure that expenditure, I would like to enter into some investments. Yes, to secure some expenditure, I would like to enter into some investments. For example, if it's a cost, and I know today you incur cost, means today you require to, you put it into the like P&L account, you book an expenditure. But are you allegedly going to pay today? No ma'am, we are not going to pay today. We will be paying after 5 years. So what we create? A liability we create, right? So what's the name of liability? It's not my normal payables, it's DBO, sorry, it's DBO. It's defined benefit obligation. And I told you that somewhere around we create an asset. Why? Why asset? Ma'am, over here it's an obligation. And if you remember, I told you that after the end of 5th year, we will not pay cash. We will have some investments and we will utilize the investments and pay them. That means it's known as over here plan assets. There are nothing other than investments which the company has to do. It's the investments which the company has to do. Simple. So if I am having any obligation, for example, so what I'll be having, guys, on the obligation, definitely I'll be having, if I'm having some obligation I have to pay, like for example I have taken up a loan. So interest is an expense you have to pay, yes. So over here it becomes interest expense. Over here if I'm having any investments, don't you think I'll be getting some amount of let's say interest on that? Yeah ma'am, like for example if I'm having any investments, so yeah, on that also I am supposed to receive interest. So here also I'll get the interest income. So ma'am, I am having only one profit and loss account. Yeah, in that, just understand. Over here I'm having interest expense. Over here I'm having interest income. For example, my interest expense is $5,000 and my interest income is $1,000. Can I show $4,000 as a net expense? What if I say you yes? Yes, students. See, people will not understand these concepts because they try to mug up. See, it's nothing like mugging up. Over here in IS 19, students, there is no concept of D, B, O and planned assets both the ways. For example, if I'm talking to you about, just give me a minute. Okay, if I'm talking to you about deferred tax, you must be knowing that when it's deferred tax, it can be either the deferred tax asset or it can be either the deferred tax liability. Okay, means you can net it off. Same way, I can either be having a obligation, I can either be having a asset. Not both. I need to settle it off. Same way over here also, I want to net it off. Okay, I netted it off. Then what happened? For example, if in the current year, if you want to add more things to the obligation, it's current service cost. Over here, for example, if I want to pay the benefits, means in the current year, let's say some employees are getting retired. So I have to pay them. I have to pay them what, guys? I have to pay them whatever the gratuity is planned. So what I will do? Ma'am, I will reduce my obligation because I have already created a payable. So payable account debit, that is DBO account debit to what? Cash? No. I have created an asset for that, right? So I will reduce the plan assets. Yes. So there is a concept of known as benefits paid. If I want to, let's say, add more investments, I can do what? It's known as contribution. Yes. So students, these are certain words which we need to know. Okay, these are certain words which we need to know. Up next, we have one more concept. Like, based on that only, you remember, I'll give you an example in the last class. For example, let's say I said 100 employees are there in my company. 100 employees are there, and I expect 10% as their salary getting incremented. So yeah, the incremental salary. And what I thought, okay, Baba, I'll give them the gratuity at the rate of, let's say 5%. Okay, 5%. So as to they need to work. They need to provide me service for how many years? Let's say service of 7 years. Cool. So what are the figures I have taken? So there are 100 employees, 10% increment, 5 years gratuity and 7 years life. So students, can you tell me, if I thought today that there are 100 employees going to be there, so I'll book an expenditure accordingly. Do you think legitimately till 7 years you will be having 100 employees only? Or some of those employees might leave? Yeah, may leave, ma'am. Some of them may not be there till that time. So every time I have to book an expenditure, for example, it's like 100 employees. What things are not constant? Not constant. What things are not constant, guys? Ma'am, 100 employees. Maybe they'll be there, maybe they'll not be there. For example, if I told you, okay, salary is getting increased by 10%, if I told you, do you think all the employees will be working well so that they get increments? Maybe not. Maybe not. So this 10% salary increment is also not constant. If you work better, maybe we can give you 12% increment. If you work very bad, maybe we can give you 8%. Maybe we cannot give you. It's anything. So maybe that is not constant. Okay. So if these two things are not constant, if I book every year the expenditure, suppose for these expenditures, for this year I expected 100 employees having 10% increment, etc., etc. I thought, okay, in the first year, I thought my expense will be, current year's expense could be like $7,000. In the second year, considering the changes, I thought, okay, no, your liability should not be 7. It should be only $6,000. Liability should be less. Oh, are you happy or not? The company is happy. Company is very happy. You are saving some cost, right? The company is very happy. If the company is happy by how much? Yeah, my students knows this thing only. The way I am telling you, I explain that way only. So yes, if there is a difference of this and this, ma'am, So initially on day 1 I thought my expenditure needs to be, and my expenditure debit to obligation, DBO obligation, will be 7,000. But now students, it eventually needs to be 6,000. So what I should do? Ma'am, you're supposed to reduce your liability. Yeah, so I'll debit it. So second year, I will debit my DBO. DBO account debit by 1,000 so that it becomes 6,000. To what? No, this is important. To what? Yeah, it's clear, ma'am. It's a gain. It's a gain. Gain of how much? 1,000. Gain of 1,000. But where it will go? Will it go in P&L account? This is the most important thing. Will it go in P&L account? Yeah, ma'am, it should go. Are you sure? No. Then, yeah, it should go in other comprehensive income. Why? Why it should go in other comprehensive income, guys? Students, please try to understand. Please try to understand. In the second year, if there are changes, don't you think in the third year also there can be changes? In the fourth year also there can be changes. Fifth year, sixth year, seventh year. Ma'am, it's a long way to go. Yes. If there is a possibility, that the things can change eventually, guys, then it's not proper to every time book P&L account, P&L account, P&L account. Like you remember, in the concept of IS 16, we understood that if there is some changes, if required, I can book directly where, guys? I can book directly in my OCI, like a reserve, and I can adjust from there. And at the actual time of settlement, actual means actual, the last day. Yeah, that is at the actual time. At the actual time of settlement means the last day. At the year end, seventh year end, last day. For example, last day, what happened? I have created a DBO. My obligation is dollar, let's say 7,000, and I need to settle it. I need to make a settlement. This is also a word, settlement, at the rate of dollar 4,000 only. Oh wow, ma'am, that is a gain. Okay. And let's say in the previous years, I have already created an OCI gain of 1,000, sorry. I have already created a reserve. So what will be my gain, guys? So first of all, I need to reduce my obligation. Yeah. So maybe I can debit my obligation and I want to pay it, right? I want to settle it. So maybe it's a gain, right? It's a gain. So what I can do? A portion of gain of 3,000 could be my P&L statement. But out of which, if you have transferred OCI 1, so please reserve OCI, please reverse OCI and put it into P&L account. So yeah, we'll be understanding all the stuff very clearly with some or the other entries. So when it is a gain, actual settlement gain, it goes in P&L account, P&L statement. But every time which is getting changed, so that are certain assumptions, things getting changed. So that is known as actuarial gains or losses. Actuarial. Please remember, your gains, your losses, it goes in direct OCI and not to P&L. Yes. Please keep these things into your consideration because it is important. People make mistakes over here only. Okay. I hope it's clear. If you guys don't are feeling difficulty, then obviously you have a superb option of seeing the recording also. Like you can pause it and see it again. Okay. Students, we considered about 100. What about 10? Okay. Ma'am, what about this gratuity? If you initially thought like your gratuity was 5%. Yeah. If I thought like, ma'am, my gratuity on day 1 was 5%, we thought of. Is gratuity something which is going to change every year? Ma'am, no. It's something which is known as a plan. Okay, yeah, it's something like a planned. Like it's planned on day 1, which needs to be same. But what if I say you, COVID hits and government has made an announcement that every company needs to reduce the percentage of gratuity. So because of all those stuff, let's say, the company thought like whatever 5% gratuity the company was supposed to pay has turned around to be 3%. Company ke liye, for company, whether it will be gain or loss. And for company, it's a gain. Why? Arey Baba, 2% less expenditure you have to book. So already if you have booked an obligation, it's a gain. So if it's a gain, what is this? What's the name? Yeah. Now we have a different name which is known as past service cost. What's past service cost? Something which is incurred in past. Because of what? Because of changes in cut short. From 5 it went to 3%. What's that cutting? It's known as curtailment. It's known as curtailment. Yes. So curtailment. So what I can pass it over here, the entry is to whatever, it's past service cost debit or whatever the expenses, or if you have any DBO, that to P&L statements. Yeah, it is basically that. It's a gain. Yeah, P&L means nothing other than the past service cost. Okay, it is to be made like that way. And maybe debit if you have put an obligation you have created, then you can debit the DBO account, debit to past service cost to P&L statement. Cool. I hope you guys are getting it. Yes or no? Yeah. But if it's a reverse scenario, reverse means legitimately the reverse case. For example, instead of gratuity, your thought was like, let's say 5%, it increased to, let's say 10, no, let's say 12%. So it will be easy for you to calculate 12%. So what's this increase? Increase means there is a new word for that. It is known as amendment. If there is an amendment in any plans, so because of that you have to pay more 7%. So you'll not be happy. It's a loss for you. So what entry can I pass? Pass service cost debit means P&L account debit, loss to what? To DBO. So you have to create more obligation. That's all. That's all. Seriously, that's all. So maybe student will find these things difficult to understand, but students, please don't worry. We have beautiful questions for that. So it can never be difficult. It can never be difficult for sure. Now I'll just summarize things over here. I told you there are certain different words which we need to know in the defined benefit plans. So what are the things that we understood it? First, current service cost means current year what am I contributing towards the defined benefit obligation, booking and expenditure for. Instead of that, it's an obligation. In front of that, we have to create an asset. Both the places I get interest, both the places I have to put some or the other way. Like in plan assets I have to contribute it, and in current service cost I need to expend something in the current year. Okay, then we have any changes. So it can be a term of settlement at the final settlement. If, like I told you, the gratuities percentage changes, that is known as, either it can be because of amendments or curtailment. So whatever I am doing it, plus or minus, where it is going to go? Yes guys, it's known as past service cost. Then guys, we have a concept of asset ceiling. So that I'll do it along with the question only. So for right now, I'm okay to share this much things only with you all. Then, yeah, I don't want to save it right now. For students, we'll be doing it with one beautiful question. Yeah, again, that will make our concepts getting more clear. So this all stuff you feel like, ma'am, it's so difficult to understand. Like, it's not so easy. Yeah, it's not so easy. But what if I say, you know, it's not difficult, it's easy. For that, yeah, definitely we need to practice some questions, and without any further delay, I would like to just open it so that we can practice the questions. Yeah. Yeah, students, don't worry, huh? This all things happens to me very often. Yeah, it's coming now. Okay. Let it come. SBR, my day 3 revision, my IS 19 questions. If you can see, I've taken up some solutions, questions. Yeah, let it get open. And for me, it's getting open, guys. Yeah, need not worry. Yeah, is it there? Cool, cool. Okay, students. Now there is a position that we have to solve some questions, and yeah, without any further delay, we will be doing the same question. Same question means whatever concept I explain you was something I wanted to explain you in the last class, but eventually it took a lot of time. So yeah, we will be understanding it because this is important. Because this is important, we'll be not going very fast. Okay, cool. Chalo. Yeah. So let's begin with the question. So what have they asked us, students? Please read that first. So this is something I have made it from my notes, which I do have. So cool. So as on 1st Jan 20x2, so yeah, I told you something in the paper they will be giving you. I'm talking to you about the defined benefit plans, okay? Just try to understand. I'll just open up a new sheet for us. Yeah, students, when it is known as defined benefit plan, and if they give you the question now, students, they'll surely give you what you know. They'll surely give you what you know. They'll be giving you the opening balance of defined benefit obligation. They'll be giving you an opening balance of what? The plan assets. What's plan assets, ma'am? Certain investments, okay? They'll be giving you some percentage of discounting factor. That is nothing other than we have to add on interest. Over here also we have to add on interest. Yeah, understand. Then what they'll be giving you, guys? Then they'll be giving you in the current year. Had I made any like current service cost? So I add it in the liability. And if they have given in the investments, they'll be giving you maybe some or the other contribution. So please add contribution to them. Then if required, they'll be giving you all the benefits have been deducted. So please deduct all the benefits. And students, they'll be giving you just that, the closing balance, year-end balance, that is known as the present value of DBO, present value of defined benefit obligations, and the fair value of the plan assets. So we have to compare whatever value I got it and whatever they have given, is there any change or not? So you will be wondering, ma'am, what is all this? We are not getting a single word also. So yes, students, for these only I am going to explain you clearly. You know what, students, for this this standard now, it's something like whenever we are having some expenditure upcoming, maybe in the next year or after 5 years, so expenditure will be there. This is my liability, but beyond that liability, this is my liability portion, this is my asset portion. So what I am supposed to do is, liability I am going to pay interest on that. Maybe I'll more incur a liability, I can do less liability by paying some of the other things, like just something like it goes on adjustments in the liability. Same way I have to make certain adjustments in the asset also. So we need to think, we need to plan accordingly. Okay, so yeah, without any further delay, let us understand this. At 1st Jan 20x2, basically the fair value, just get with the words, on 1st Jan 20x2, the fair value of the asset of the defined benefit plan are at this. Okay, so what have they given us, guys? Okay, they have given me, okay, I'll write it like that only. I'll just reduce this size so that it is easily visible. Okay, on 1st Jan 20x2, the fair value of asset is given. Asset means, students, when it is asset, it's a plan, investment plan. The opening balance is given of 11 lakhs. Cool. Okay. They have given what? And the present value of the defined benefit obligation. Okay, on that day they have given the liability also. So on the same day, 1/1/2020, 2002, whatever it is, present value of DBO is given how much? 1250. So if it's a asset and liability, can I bifurcate in the financial statement? Yeah, I can do. What they have given? Okay, my year ends on 31st December. Okay. At the year end on 31st December, yeah, try to understand it. At 31st December, what happened? 31st December 20x2, the plan received the contribution from the employer, means the plan means the asset, the investments, you contributed more. Okay, the plan means the investment has increased by the employer of 490. Okay, so he has increased his investments. Cool. And has paid out the benefits of 190, means in the asset side, like in the investments, basically what they did, they have added more investments. Okay, you can add more investments. Yeah, they have added more investments, and out of the investments they have paid out some liability also. So their liability will be reduced, yeah, because they have paid, and even their assets will be reduced because out of that assets they make the payment. Correct? Okay, yeah, this all can be the stuff. Cool. This is given in the question. Up next, what they have given, if you can read this. Acha, the current service cost, yeah, every year the person has to book an expenditure in the P&L account. The current service cost was 360. Okay, and the discounting factor is given at the rate of 6%, which is nothing other than the interest element. Okay, very cool, very cool, very easy, like nothing it is given which is difficult. Okay, very easy. After these transactions, the fair value, acha, after considering all the stuff, year end, I told you, end May, in the year end, they'll be giving you either the present value of DBO and the fair value of asset. They'll be providing you with these stuffs for sure. So what they have given, at the year end, the fair value of the planned asset is 1.5 millions. Okay, it's 1.5 millions, and over here it's 1,553,600. Okay, cool. The liability, the present value of defined liability. What they have asked us, calculate the gains and losses if required to be measured through OCI, other comprehensive income. What's other comprehensive income? Something changes which is happening, which you think like it is going to happen it every year. It's not something which is discrete that you have to put it in your P&L account. And please illustrate how the pension plans will be treated in the statement of profit and loss account and other income, other comprehensive income and the financial position. Cool. So students, do take the time and please solve these questions also, because it is legitimately very important. And I hope you guys have understood this question for first. Now it's our responsibility. Students, this is just for the thing I'm going to explain you, because for making these things easy, I'm explaining you. Okay, for making these things easy, I'm explaining you the way I'm doing. Okay, first of all, I need to prepare my financial position. Let me prepare my financial position for the first. Okay, this is my financial position. Okay, I'm taking up till D, because no, not D. I need to take it up till H for sure, because I want to make it big and I want you guys to understand it. I'm just going it slow for sure. Yeah. Okay, students. Now I want us to understand the concept, which is again very important. Okay, which is very important. Pakka it's important. Okay. So you'll be feeling, ma'am, it's very easy, then why are you saying so much? Okay, now in the financial position, students, I would just like to make the way like which is very easy again, like something which we used to do it in the schoolings. Yeah, in the schoolings. So what I used to make, ma'am, over here I used to prepare the liabilities. Yes, I used to prepare the assets over here. Yeah, cool. So has they given any type of assets and liabilities to us? Okay, for that let me read it, the question again, and yeah, we are definitely going to understand it for sure. And this is what I have just made it to like bifurcate things, but even if I don't bifurcate, now guys, you'll understand it for sure. Okay, now what they have given, on 1st Jan 20x2, the fair value of the opening balance of the asset was 11 lakhs and the obligation was 1250. Cool, 1250 and 11 lakhs. Okay, so I just have to post it over here. What is asset? Ma'am, it's my plan assets. How much is my plan assets? Ma'am, it's 11 lakhs. So please write it. Plan assets are 11 lakhs. Plan assets are 11 lakhs. And what are my liabilities? What is my obligation? It's 1250. Yes, ma'am, my obligation is 1250. Cool. What have they given up though? Okay, so this is basically my opening situation. So it's my opening balance. Cool. Nothing else, nothing more than that. Yeah, opening balance is this. On that, students, what I have to do it, ma'am, every year now you have to add on interest. But what have they given? At 31st December means year end. At the year end, The plan received a contribution means the person is going to contribute more 490. Okay, so add more contribution to the plan assets means with these what I have to do on 31st December, I have to add how much, ma'am? I have to add my assets with 490. You have to add on more. Yes, for sure. What they have given, and they paid the benefits out of 190. Okay, if they paid the benefits out of 190, that means will the liability be reduced or will the asset be also reduced? If it's contribution, okay, and you want to increase the asset, okay, just try to understand. I'll be ahead with the accounting entries also. If you want to contribute it, means you have to increase your asset. So asset needs to be increased, means plan assets account debit, yeah, to contribution. Na contribution means maybe you will be paying cash and something, so it's contributing. Yeah, now what happened, ma'am? We have to pay the benefits. If I want to pay the benefits, means you have to adjust that asset, you have to reduce the asset and settle your obligation. If you settle the obligation, means your obligation will be reduced, your asset will be reduced. So what entry can I pass? Can I pass like this? Like if I want to settle the obligation, मुझे liability कम करना है, I want to reduce liability, can I debit the liability, DBO account debit to plan assets? Yeah, if it's this, what I have to do, ma'am? With the assets you have to reduce it. Even in the liability I am supposed to reduce things. Agreed? Yes. Can I do so? Yes, I can do so. Why not? I can do so, obviously. So I am supposed to pay the benefits of 190. I have to reduce it for sure, but I have to reduce it from here also, in the assets also, and in the liability section also. So from where I will be reducing it, guys? I will be reducing it from both the phases. I will reducing the benefits from the assets and the liabilities, and this is something which I have to do it very common in both the things. Yeah, easy. First para is done. Second, current service cost. Ma'am, we know current service cost entry. I'll always put up the entry. Ma'am, what is my current service cost? Acha, current service cost account debit, that is P&L account. It comes through P&L account to defined benefit obligation. Okay, ma'am, it's an obligation of 360. Okay, please add it in the liability. Please add it in the liability as your current service cost, which you have to put it up in the P&L statement. Yeah, this is my extra expenditure which I have to book it. That's all. What up next they have given in the question? And the discounting rate is given, and the discounting rate is 6%. So over here in the obligations I have to pay 6% interest. So what it comes up, students, if you see, it comes up at the rate of 1250. Okay, yeah, okay, just give me a minute. Yeah, it comes to 1250 into 6%. Yeah. So what it is, guys, it's an expenditure, it's an expense you have to book, so it's a loss. Like I can do minus means in the P&L account it is an expense. Similarly, if I'm telling you plan assets, it's an income of 6%. So how much it is coming? Income of 6%. Yeah, my income of 6% comes around to be this much. Yeah, is it this 66,000? Okay, so how will your financial statement look like? Somewhere you are having expense, interest income. Can I do net? Yes, ma'am, you can obviously do net. If I'm doing anything net, what is my net? What is my net? Expense or income? Yes, ma'am, it's my net interest expense. Expense of how much, guys? If I do net, my expense is 75,000 minus my income is 66. Can I write like this, 9,000 as my interest expense? Yes, ma'am, why not? We can write this. Yes, we can write this. I think you guys have no confusion in that. Till now it's no confusion. So we have completed the first part, the second part, the third part. Now it's at the position we have to show year end. They have shown the closing balance of asset is year end. The closing balance of asset is 1.5 and the liability is this. Cool. So what I have to do, year end, I have to book a year end also. So I'll just mark it that way. Okay, so year end, what is my asset? Okay, for that I have to see what is the fair value of the asset given. Is it 15? Yeah, ma'am, it's 15 lakhs given over here. So this is 15. And what's the fair value or the present value of the liability? The present value of the liability turns around to be 15, something like that. Can I book like that? 15, 53, 600? Yeah. If they have given all those stuff to you, what eventually you think? See, it's a financial position where either I can write plan assets, either I can write the liabilities, because I want to net it off. Both the things I cannot write it. Now, after giving all those stuffs, They have asked us, okay, please find the present value is this. The closing amount is this. So what is your thought? So what do you think? How much eventually your assets balance was? Okay, so I'll figure it out. Okay, means what should eventually my plan assets value look like? So you'll consider this. Eventually, you were having an asset of 11 lakhs. Yeah. On that you got an interest of 66k. On that you have added more contribution and you have paid an expenditure or the benefits. So eventually, what should be? What do you think? What should be your closing balance? What should be your closing balance? Eventually, this should be my closing balance. How much? I thought like, okay, this much is my asset. On that I will get the interest and I'll contribute it more. And yeah, this is my expense which I have paid it, so minus. So eventually guys, understand, eventually your assets should be 1466. But you know, if there is any change in the coming years, because there could be some actuarial changes, because of the changes, your assets balance in the market has increased. Ma'am, it's increased now. I am happy. Increased by how much? You can find out the difference, ma'am. Increased by how much, guys? Increased by 34,000. Now where this gain will go? Will this gain go in P&L account? No, not at all. It's not a past service cost. It's a gain which we need to book it in the OCI. Are you getting it? Yes. So this gain is going to go in the OCI and not to the P&L account. Cool. Because this is a gain. Yeah. With all those stuff. Clear. Hey, up next. Have they given anything for liability? If I tell you, okay, please book it for liability, can you please give me the liability? Yeah. Same way, you find that the fair value of the liability, present value is 1553. But what you are thinking your liability should be, how much it should be, guys? Over here, my liability should be, if I just take up the total, it should be like, this much was my opening liability. On that, this is an interest expense. This is a current year and this much I paid it. Okay, oh my god, it's very bad, isn't it? So you thought your liability should be 1495, but your present value of the liability turns around to be 1553. Ma'am, it's very much. Yeah, it's a loss. Loss by how much, guys? Ma'am, it's a loss. Loss of 58,600. Now, where should this loss go? So yeah, we know it is any loss, it is going to go in P&L account. No, ma'am, it's going to go in OCI only. P&L only, the settlement thing will go and not all those stuffs. So somewhere if I'm having loss, somewhere if I'm having gain, we have to do a net off. So what net off I can do? This is a loss and this is a gain. Can I show 24,600 as a net loss for what in the OCI? Yes, I can show. Yes, I can show. Yes, I can show. This is my net loss. Okay. There is one more concept which I just didn't explain you, but I wanted to explain you right now. Whenever you are, I told you, okay, we just have to show what the net things. We just have to show the net things, right? Net of things. Means somewhere I cannot write DBO in my financial statement. Somewhere I cannot write the plan assets. It needs to be netted off when at the year end. So what do you think? Year end on 31st, 12, 20, whatever the year is. My asset is 15. My liabilities are 1553. Ma'am, it's a net loss. Means it's a net obligation, right? It's a net obligation. So we have a word. What's the word? It's basically known as NDB. So net defined benefit obligation, or it can be net defined benefit asset. So over here the liability is more, so it's known as net defined benefit obligation. How much? Please take up the difference. You get the value. What's the difference? My obligation is how much? This minus this. So my net value is 53,600. Clear? Yeah, easy. Now, just students think of, okay, what entry can I pass for this gain? Ma'am, it's gain now. So OCI account will be credited because it is not P&L. So credit and debit what? I have to reduce my, what I have to reduce? I can reduce my obligation or I can add my assets. It's both the ways. Okay, you can do both the ways. It is all dependent upon the position that you guys are handling it. Okay, so yeah, it can be this way. Like gain account will be their way. So yeah, we can either increase the plan assets or either we can decrease the obligation. It is dependent upon how the question is framed. And if it is a loss, what I will do, ma'am, I will debit the OCI, right? I will debit OCI because it's a loss. 2, I have to create more liability. That is posture. Yes, ma'am. Can I book like this? Yeah, we can book like this for loss. Okay, easy. Ma'am, so they have told us we have to create an SOPL also. We have to create a PNL account also. Yeah, we have to create a PNL account also. So SOPL, if I create it, what are the expenditure and income I have to book? First, I was having some interest thing, yeah. Interest, somewhere I'm having expenses also. Somewhere I'm having income also. So we have to book the net interest. And in the current year, you remember, we have some current service cost. Yes, even that is an expenditure. This is an expenditure. Yeah. So what is my net interest? This is my expenditure which I booked it. Minus this much is the income. So yeah, it's a net expenses cost. Yeah, 59,000. Okay. And what is the current service cost? Yeah, if you remember over here, we had a current service cost of 360 ma'am. Yeah. So your total expenditure goes up in your P&L statement, turns around to be this much. Are you fine with it? Is it easy? So yes students, this is also the statement of profit and loss account, which I tried to make you understand in a very less time. Yeah, is it easy? Is it simple? Are we good with that? Yeah. Can I go ahead? Yeah. We'll be doing one more question which is there from ACCA resources. Yeah, this is something I have did it in my students with my students in the class also. So yeah, they know that it's not so difficult. But yeah students, now we will not take so much of time because it is going to be very quick for sure. Okay, just read it what they have asked us. Explain with the suitable calculations the amount to recognize the PNL and OCI income impacting the asset ceiling. So what is known as asset ceiling? Okay, there is a concept which is known as asset ceiling. Means, see students, if I'm having over here the liability, yeah, I created a liability. In front of that liability, I created an asset. Okay, for example, my liability is 100. Okay, for example, my liability, my obligation is $100, and in front of that, if I've created an asset, or I can say investment of let's say 140. Oh ma'am, it's more, right? So can I utilize 140 full? No ma'am, I can settle it 100. Still I'll be having 40. Still I'll be having 40. So what they have told, your asset ceiling should be like at the rate of whatever the investments are, it should be minimum 10% of that. That means you should at least keep a reserve of 10%. 10% means 140 into 10% means at least 14 should be your reserve. $14 you should keep. So what happened? My liability was 100. My assets are 140. Yeah. So what I did, I settled it off first 100. So minus 100. So now I'm having remaining assets of 40, out of which I can still further utilize to settle off anything else, so that my balance should be 14 only. So yeah, basically I can use more 28 that way. It's my asset ceiling. So that you know, there is a position which is known as liquidity crunches. So yeah, liquidity crunches should not come in the existence that way. Okay. Yeah, we know that one concept. Yeah, just give me a minute. Oh, I'm so sorry. I think it is not going to go now. Aha, it takes a lot of time to come up. Yeah, no worries. No, I'll not save it. And yeah, again I'll open it. Yeah, I have made the answers for you guys, so we can go ahead and read it, so it will be very quick enough. Okay, yeah, please try to understand it. Please try to understand it. Okay, yes. So there is a company. The company manages a defined benefit plan. Okay, so there is a DVP. I told you exam May DVP will come. At 1st Jan 20x8, the fair value of the plan asset was estimated 137. Means ma'am, the opening balance is 137. Okay, try to understand it. Try to understand it. The present value of the liability is 122. Ma'am, opening liability is 122. I have made it over here. Can you please see it? Yeah ma'am. My plan assets are this. My opening liability is this. Okay, are you feeling confusion if I show you like that? No, it's easy, right? Okay, otherwise if you want, I can just open up the plain thing, and yeah, we can make it very fast also. I'm okay with that. Just give me a minute. I just cancelled it for once. Yeah. Is it something which is clearly visible to you all guys? Yeah, it's there, I think. Yeah, I'll make it. Yeah, cool. Chalo. Give me a minute. Meantime, you can read the question, guys. Yeah. The company manages the defined benefit plans over here. Yeah, the defined benefit plans. What are the question? Defined benefit plans is how much, guys? Yeah, they have provided us with the amount of opening balance, that is on the fair value was 137 for asset and 122 for liability. So what I'll do it now, I'll start writing the thing, and yeah, I will like do it small way. That is the financial liability position. I will put an asset and I will put an income. So yeah, what it is it so? Yeah. My plan assets are 137. Yeah, my plan assets are 137. My liability is 122. Cool. The asset ceiling has been calculated at 4 millions. So that means at the year end, if I'm saying, or year start also, for example, the fair value of my asset is 137. And if I settle my liability was 122. So how much extra I'm having? Yeah. Am I having 15 as an extra part? Yeah, am I having 15 extra? What do you think is 15 extra? Yeah, ma'am. 15 is extra, right? If 15 is extra, what they have told, your asset ceiling only needs to be 4. So extra, how much you can utilize it, guys? Extra 9 millions I can utilize it, right? Agreed. 9, can I utilize it? Yes or no? Yeah, we can actually utilize it. So my difference is basically how much? 15. And minimum I have to keep it how much? 4 I have to keep it. So I can further like utilize it how much? Yeah, why around 9? Sorry, 15 minus 4 is basically 11. Okay, 11 I can utilize it. So what I can write it over here, ma'am, the difference is basically, okay, the difference is basically 15. Yeah, it's the 15 difference. So minimum I have to keep how much? Asset ceiling of 9. So how much can I utilize it further? I can, yeah, ma'am, utilize it 11. Cool. Up next, what they have given in the question. Try to understand it, please. Okay, the discount rate means the interest. Interest is 4%. Cool. If it's 4%, add interest on liability and add interest on income also. Easy. 4% interest. So if it's 4% interest, what it will be, ma'am? It will be 4% of this. So this becomes my expense. My expense is 4.8. My income is more. So it will be net income by how much, guys? Please take up the difference. So ma'am, I'll be definitely having a net income of how much? 0.6. So if I take up over here, I put it over here, it's 0.6. Like it's the difference between them. Yeah, it's a net income. It's a net income of 0.6. Cool. Very easy. If it's 0.6, similarly think of, okay, if you keep a minimum asset, or if you keep a minimum yeah, is it visible clearly? Yeah. If you keep a minimum like asset ceiling of 4, how much interest you have to like get it? Like if it's an interest, ma'am, obviously that also 4%. Simple. So it's 0.16 for that also. Simple, very simple. And if it's for 11, again it is 4%. Cool. I just made it for us. Up next, what have they given in the question? Let's read it. Acha, the normal details are given, very easy details that you should know. Hey, cash contribution means you are adding more investments. So add it to the asset. Ma'am, benefits paid means I settled it from obligation also, I settled it from asset also. So reduce it from asset plus, plus means you have to, reduce it more from where? Reduce it from both asset and liability. So, and last, current service cost, please add it in the liability of 765. So yeah, can I do it? Very simple. Is it easy? Yes. So first of all, if I'm taking up the total, what it is, if I'm taking up both the total, if I'm taking up this total only here till here, what is my total of all this stuff till here? If I'm taking up the total, is it so 127 and 142? Okay, yeah, cool. That is not a big issue. Okay, cool. Now, if they have given me the current service cost, it is my expenses which I have to reduce it from my liability. Yeah, if they have given me any current contribution, I have to add it. If they have given benefits, I have to reduce it from both the phases. Till here clear? Now they have given something more. Please understand that. At 31st December 2008, the asset ceiling year end, year end. They have calculated the asset ceiling of 11 millions. Cool. During the year, please understand it. During the year, there was a plan curtailment. Oh, plan curtailment means you initially thought that you have to pay something more, but now it's cut short. So it's a gain for you, right? It's something like a gain for me. Yeah, so there is a plan curtailment which resulted in a gain on settlement of $3 million. Oh wow, if it's a gain, where it is going to go? I explained you two things if you remember, right? If it's a actuarial thing, if it's an actuarial means actuarial and not the like amendments and curtailments, something which is not service, it goes in OCI. But when it is settlement, it goes in P&L account as an income, right? If it's a settlement, it's -3 because from my from my expense I have to reduce it. Agreed? Yeah, ma'am. So it's my curtailment. So it's settlement. Good. You are happy. So some losses you have to reduce, and now I am supposed to get the closing balance, like what it is, what should it eventually be, So can I do like that, ma'am? Yeah, 127 plus cost minus this. Is it 122 or like 123? Cool. Yeah, 123. And same way if I do it for this, what will I get? Yeah, please do it, guys. Yeah, are you getting this stuff? 143. Yeah, I am to getting it. Yeah, 143.48 that way. So yeah, if I'm doing it, I'll definitely get this 143.48. Cool. Yeah, easy. Up next, what they have given in the question. Achha, after completing that curtailment, the actuary valued the plan assets. Achha means the closing thing on the last day was 148 for asset and 136 for my liability. So yeah, let's go ahead and book it over here. Okay, 136 for your liability and 148 for your assets. So ma'am, why have I kept this space? You remember, we have to find it out what you actually thought and what eventually it is. So ma'am, I thought my expenditure needs to be 122, but the liability turns around to be 136. Ma'am, it's very much. Ma'am, it's a loss. Loss of how much? Ma'am, loss of 13. But where it will go? Will it go to P&L account? No ma'am, it will go to OCI. It will go to OCI. Agreed? Yes. And what about income, guys? It's more, right? It's more. So definitely it is going to go in what? It's going to go in your gain as a P&L. Agreed? Yes or no? Very easy. Very easy. Yes. So if I'm saying you what is the net of for the gain and losses, ma'am, my losses are 13 and my gain is this much. So obviously it's a loss, net loss. Sure, ma'am, it's a net loss. So how much? Why it's not coming? I don't know. It's a net loss of 8.6. And if I say over here, ma'am, it's a gain. Your asset is more. So it's a net loss. Over here, it's a net loss. And over here, if you see, it's known as the net defined benefit. What asset? Over here, it will be now the asset. And it is a net OCI loss. Agreed? Yes, clear or not? Yeah, pakka clear? Yes. Now what if I say you, okay, that solution, if you want to see, yeah, how we are going to plan it. I think this way we do it and it becomes very easy for us to understand. Yeah, to understand it's very easy. But how will I answer it in my paper? To answer it in my paper, I have to write like this, all the stuff. Like what was the changes, yeah, and how we are going to go ahead with that and all the stuff. If you can see it, you'll definitely get it. So yes, students, I don't want to say the things. Yeah, obviously. And yeah, with these, like I tried explaining you with all the concepts which are there, okay? So yeah, you can plan a lot of things, yeah, obviously, and you have to practice a lot of things for IAS 19, and that is for sure. And with these guys, we have completed IAS 19, and I hope you understood it very well. Yeah, was there any doubt? Guys, if you feel any doubt and if you want me to do any questions for you guys, please message me in the Telegram, you can message me in the Instagram, you can message me in the chats, you can message me. So yeah, we can come up with the videos so that we can have a good reach. Like yeah, I'm telling you guys, like it's very less months, and whenever you are going to visit the like see the video, have an eye on the video, definitely if you have any doubts in that time also, you are free to always message me. Okay, so yeah, students, with these we have completed IAS 19, and I hope you understood it. Yes. And let's take a small break, and later on we are going to start with the important channel which is known as IFRS 9, IS 32. I'll be taking care of all the stuffs which is there in a quicker way. Okay, so this is what we were having the agenda for the day, but eventually yesterday I was not able to complete this standard, and that's the reason we have to just lag it, but it's not an issue. Okay, so yeah, we'll resume it after 5 minutes, so take a small break. So hello students, I welcome you all again. Yeah, after a short break, yeah, we are just going to resume with the most important standard. Like, it's not so much important from the perspective of weightage of the examination, but yeah, we know every marks when it counts. So definitely students, I want you all to know the standard very well. Okay, I want you all to know the standard very well. So what is that standard? What is that chapter? Which people have phobia. I am telling you, like, I have seen a lot of students having a phobia, like, "Ma'am, this standard is very difficult, ma'am, this standard is very difficult, we don't get to know this, like, even if we understand it, we are not so sure, like, how will I interpret it in my examination?" So yes students, to revise that standard in a shorter period of time, we are going to start up with the chapter name, which is one of my favorite, my favorite, that is, yes, financial instruments. Yes students, we are going to start with the financial instruments. So what is the meaning of financial instruments? First of all, what is finance? So is it something related to like FM? Ma'am, it's not there for SBR. So why are we understanding this? So you would have heard the words, yeah, in the chapter you would have heard somewhere the bonds, yeah, equity, yes ma'am, preference shares. Yes, I'm not expecting you guys to sit for the first time, huh, without reading this standard. Like, I know you would have understood, you would have heard about this standard for sure. Yeah. So equity, bonds, preference share, ma'am. Then we have some, ma'am, derivatives, ma'am. We have some hedgings. Yeah. So are we all going to understand the base behind all those stuffs? To be very frank, not so much, but I'll explain you from the overview for sure. Students, when it comes to SBR, we have all these concepts in the APM. Guys who have interest in all these terms, like it is bonds, equities, and hedging and all, I'm legitimately telling you guys, the APM, if you have not the AFM, if you have not given it AFM, please go ahead with AFM, because students who take up the exemptions and come, they don't know the meaning, like, they don't know where they can excel more. So I personally feel like the best options which you are supposed to take in the like optional papers turns around to be ATX, which gives you a good knowledge of the UK taxation, and AFM. Like, because I am more into the practical part, so I maybe recommend that, maybe, I don't know. Okay, cool. So yes students, okay, so all the stuffs, are we going to understand the code, like how to calculate it, yes or no? No, I'll tell you why. Then why all these concepts are there in SPR? You just imagine, whatever transaction happens, some or the other place, I told you, some or the other place, it needs to have a place to be booked into the financial statements, So where will I book? Obviously ma'am, I have two stuffs that you told me. Yeah, it can be either the financial position, yes, it can be either the P&L account. Yeah, so what we will do, ma'am, we have to book it for sure, we have to book it some or the other way. So yes, where I need to book it, how will I account for it, is something which we are going to learn in SBR. How we are going to account it for, where are we going to show it in the financial statements, where it will stand in the financial position, all the stuffs we are going to understand it in the SBR. So yeah, I was just about to turn off the AC, but it's not getting it off. Cool. Okay, so when it's financial instruments, this financial instruments is to be understood from a broader perspective. So before I go with the word financial instruments, if I break up, it's basically finance, something related to finance. It comes up with the terms of the financial monetary terms. Yes, instruments are something which we know, okay ma'am, something like bonds and all, like instruments which can be traded. Yeah. So if I go ahead with the term financial instrument, it has a clear-cut definition. To be at a financial instrument and to have a financial instrument, it needs to be, for one party, a financial asset. For another party, it needs to be either the financial liability or equity. Again. For one party, it needs to be a financial asset. For another party, it can be either the financial liability or equity. So that is the meaning of financial instruments. So basically, when it is an instrument, it needs to be a contract. It should be a contract between two parties. For one party, for first party, it needs to be a financial asset. For second party, it can be financial liability, or equity. So what's this financial asset, financial liability, equity? So I don't know, ma'am, the meaning. I don't know the meaning of all the stuffs. Then if I need to know the meaning of all these things, we need to understand IAS 32. Yes, students, IAS 32, International Accounting Standard 32, is all about getting to know what's the classification of, what's the meaning of all. What's the meaning of all? What's the meaning of financial asset, financial liability, and financial equity? See, before I go ahead with any of the stuffs that is known as the concepts from the bookish knowledge, I would like to explain you the most simplest thing. So like you will be also feeling like, yeah, is it so simple? Yeah, it is so simple. So let us understand it with the most simplest thing. I have prepared a financial statement for us, and with that we can understand what's the meaning of financial asset and what are the terms that are known as financial asset and what are the assets which are my normal assets, and for which standard the financial instrument chapter or the standard is going to be applicable on which instruments. Okay, so yeah, without any further delay, let me open up for you the new worksheet which I have prepared it for you all, which will make our concepts very easy, and yeah, this becomes interesting also. Yeah, it's not coming it up with the Excel. Why? Let me just check it. 3. This is chapter 3rd. Yeah, no, not the way. Yeah. I think it's clearly visible. I'll just reduce this height over here. Now students, I'm just taking up a thing. Students, now this becomes the most important part, which is actually the base. If I don't understand the base, I'll not be in the position to clear up the financial instruments. So what is the meaning of financial instruments? The base meaning of financial instruments says that it's a contract, it's a binding agreement between the parties. So guys, who all are the parties? I told you, it needs to be a contract between two parties. For one party, it can be what? For one party, it can be a financial asset. For another party, it can be either the financial liability or equity. So you will be saying, ma'am, what is the meaning of financial asset and financial liability or equity? So students, this is very small stuff which I have taken it, and in this we'll understand if it's a financial asset for one party, it can be both the things for others. So before going into the details of these, I'll just explain you one thing. This is my financial statements, okay? This is my financial statement. It's Ashwini's financial statements, my balance sheet. I have created it, okay? Very clear. In that, I have taken up with the assets, certain financial assets, certain equity and certain liabilities, okay? Certain assets and certain liabilities. So when I go ahead with the financial assets and normal assets, is there any difference between these assets? Is there any difference between the financial asset and normal asset? See, when I go ahead with the definition of asset, it is something like I am going to receive it because in the past I have incurred expenditure, and in the future I'll be receiving some of the other economic benefits. It's my asset. But then what is financial assets? It's a monetary assets. So you'll say, ma'am, what monetary? Means if in my financial statement, again, if in my financial statement, if I'm going to record any of the name, for example, if I record in my financial statements debtors, somebody else has to record in their financial statements my name as creditors. Means it gives me, the financial assets gives me an authority, a right that I am going to receive some or the other thing from somebody else. For example, over here, if you come up, if it's loans and advances, means if I have given you guys loan, so is it not my asset now that I will be getting it back from you, money? Yes. To receive that, it's my financial assets. It's my financial assets. Ma'am, receivables. Today in my books of accounts, I have recorded your name as a receivable. So you will record in your financial statements my name as payables. So yes, this is a financial asset. For example, debtors. Ma'am, it's a financial asset. Why? I will record debtors. Somebody else will record my name as a creditor. Yes, guys, this is what is known as a financial asset. So ma'am, only this much is the financial asset or something more? Something more. Okay, if I go ahead, students, please try to understand. If I made an investment in bonds, so I have returned some X company's investment in bonds, so that company will record my name and that company is obliged to pay me interest, and maybe at the end they'll pay me the redemption also. So even that is a financial asset. Yes, investment in bonds, investment in debentures, investment in preferential, everything is a financial asset for me. It's a financial asset for me. But investment in bonds, debentures and interest over here is known as financial asset, because what I'll get, guys, I'll get interest plus I'll get the principal amount at the redemption, plus principal amount at the redemption, for sure. What if I say you guys, what if I say you PPE, if I'm having property, plant and equipment, property, plant and equipment, ma'am, I have purchased it. If I am having PPE, will somebody else pay me for that? Will somebody else be liable for that? Ma'am, no. If you have purchased, you yourself have to make the payments. Agreed. If I have purchased, only I have to make the payments. So there is nobody else who is going to be liable for that. No. You just try to understand. For being a financial instrument, it needs to be for one party financial asset. For somebody else, it needs to be a financial liability. For me, if it's a debtor, for somebody else, it's a creditor. For me, it's a receivable, somebody else payable. For me, loans and advances given, they'll be having received, so they have to again make the payments. That way, it needs to work that way. But if it's a PPE, I have purchased, it's my liability to pay. So okay, that PPE, I'll only pay. So for that, we don't have any as such IFRS 9. We have IAS 16 for this, the standard. Right? Similarly for ROU asset, right of use of the asset, ma'am, we have IFRS, yes, 16. If I'm having intangible asset, which is again important, students, you just cannot ignore it, IAS 38. If I'm having an investment property, I've invested somewhere, so I'll be having IAS 40 for that. If it's an inventory, guys, I have IAS 2. So ma'am, so simple. So for all this stuff where it's financial assets, we have IFRS 9, comma, we have IAS 32. Okay, for that I'll just copy and paste it over here. So you'll be saying, ma'am, you have not covered this word, investments in equity. I'll explain you later on. For example, after 2 minutes. Okay, if it's a liability, for me, if it's a liability means for somebody else, it needs to be a financial asset. So that becomes a financial liability for me. Okay, for example, if somebody else has in his books of accounts, you are having receivables. So what will I record in my books of accounts? I'll record it payables. Simple. So for me, payable will be the financial liability. It's a financial liability for me. Agreed? Loans and advances. If you have given me loans, for me it's a financial liability because I have to incur that liability. If I have taken money from you, it's my liability, your asset. So yeah, it's my financial liability again. If it's bonds, my financial liability, because now if I have issued bonds, I have to incur liability, means I have to pay you interest, I have to pay you principal, etc., etc. If it's a debentures, again the same, ma'am, interest and principal I have to pay. Again, if the preference share, if I have issued, I have to pay you dividends, or like it's a fixed thing, plus redemption. But what if I say you, I have invested in your company in the equities. So ma'am, if I have invested in this equity, I'll make it with the different color. Yeah, if I have invested in the equity, so if I come up to you, I told like, oh ma'am, in your company is very good, I want to invest in the equity shares. Is it my financial asset? Yeah, because I am going to get some or the other thing in future, for sure. So yes ma'am, for me it's a financial asset. But guys, for you, what it is it a financial liability? Are you pakka going to give me anytime dividend? No, it's upon you. So it is not a financial liability, then it is for you financial asset. Sorry, it's for you equity. For me it's a financial asset. For you guys, you will book not in the liability, you will not book over here, somewhere over here. No, you will book my name in this equity share capital. So for you, my name will be in the equity share capital. So if I see this financial statements, so you will say, ma'am, there is something which is erroneous. Like I feel like, ma'am, there is something which is wrong. Like you will say, ma'am, over here also you have written preference shares and debentures. Yeah, ma'am, over here also you have written preference shares and debentures. Ma'am, why 2 times preference shares and debentures? Like, okay, over here I got to know, ma'am, that you said, for example, just try to understand guys. For example, for me it's a loans and advances. Yeah, for me it's a loans and advances. For somebody else, it will be the liability. Cool. For me, ma'am, it's a receivables. For somebody else, it will be a finance liability. Okay, for me it's a like investment in bond, for somebody else it's a financial liability. For me, debtors, somebody else creditors. But for me, if it is an equity investments, somebody else will write my name in the equity portion. Yeah. So for somebody else, it is an equity. What if I say you'll tell, ma'am, here also preferential capital, here also, ma'am, it can be either a liability, it can be either a financial liability, it can be either an equity. So ma'am, why both the things? Same way, ma'am, for debentures also. Even I can say for bonds also, even I can write here bonds also. So why? Have you ever heard the word convertible preferences? Yes, I'll explain you. For example, if I am the company, my company name is ABC company, yeah, and I have issued, let's say, 5,000 preference share, preference share, preference shares, 5,000 preference shares, and I gave an option, an option, an option to my holder of the preference share. If you want, you can convert it into equity shares. Oh, means right now I have given 5,000 shares, that is preference shares. If it's preference shares today, it's my obligation for sure to make the payments in the terms of dividends and all. But if in case, if you are the holder of preference share, like these are the preference shares that you are having, okay, you preference shares, you are having preference shares, so you can come up to me anytime, ma'am, take this, we want equity shares. Oh my god, if you want equity shares anytime and it's convertible, it's not at my option, it's at your option, holder's option, then ma'am, there is a doubt. Ma'am, why doubt? Can it be a financial liability or equity? Tell me now, is it a financial liability or equity? For example, the holder is having option, the holder is having option, it can be converted into equity, it can be converted into bonds. Now what to be done? Ma'am, it's a doubt. So I'll be having a risk, like I'll think, if he converted into equity, I have to book under equity. What if he didn't convert it? Then it will be my liability, which is on and on and on. So yes, in this concept, we have a beautiful concept which is known as compound financial instruments. I know you all know those words, and yeah, trust me students, if in the question comes in the exam, any question means any question, if you check and you get the word preference share, you need to get a hint, maybe it is from the compound financial instruments, when the word it is known as convertible preference share over here. It's an option of holder that I can convert it into equity. So if it's a compound financial instruments, means I'm having a doubt, maybe if he converted, then do I have to book equity, maybe if he not converted, I'll be having a financial liability. Financial liability means I have to pay cash from my pockets. But if it's equity, I'll pay them the equity. So when I'm having a doubt, what I have to do, I have to consider both the elements. I have to consider some place as financial liability, plus I have to consider some place of equity. So you'll be saying, ma'am, what is all this? I'll explain you with the questions also. So this is basically very beautiful thing. I'll just take it up. Okay, I'll not consider all those stuffs right now. Okay, yeah, maybe I can take it later, yeah, with the thing. Okay, now what's this preference share? Preference share. Okay, preference share can be like, it's not an option. If the preference share can be redeemable, can be irredeemable, can be convertible, can be cumulative. Okay, if for example it's an option of issuer means if I am issuing, just imagine if I am only issuing and I'm telling you, okay, after 2 years I am going to convert you into equity, then I can book into equity. Why? I am sure it's equity. What if it is at the option of holder? Holder ka hai to it's tension. For holder, I have to consider financial liability plus some portion of equity also, which is known as compound financial instruments. Okay, compound financial instruments. Up next over here, okay, I can just go ahead with the concepts, hedging and all, I'll be doing it later. So now, right now I don't want to save it. Okay, even these questions are something which we can do it in the later portion. Right now we want to go ahead with the PPT for first, where we will explain a lot of things. Yeah. Yes. So if I go ahead with financial instruments, it's clear cut. A contract between two parties For one party, it needs to be a financial asset where it's sure that I'll be getting cash. For another party, it needs to be a financial liability, or where he has an obligation to deliver cash. For sure, deliver cash or any other asset, or it can be an equity where he has to pay the number in equity shares. That's just one clear-cut definition of financial assets. Financial instruments. So when I go ahead with the financial instruments, students, financial instruments, this chapter, this name is inbuilt and having three standards: IAS 32, IFRS 9, and over here you'll be wondering like why it's 7 also, like why it is IFRS 7 also, why? So people will not be knowing this word of IFRS 7. Yeah, why IFRS 7 people will not be knowing? It's just about certain disclosures that we have to give. It's about some valuation, like how will I value my assets, liabilities, etc. How will I present it? So try to understand it. In this financial instruments, guys, I have three standards which we need to learn it. That is IAS 32, the financial instruments. That is a presentation which deals with how will I classify between, I have the difference between what is liability, what is financial liability and equity, and how will I present the compound financial instruments. And these are certain words I think now we are very familiar with. Okay? Yeah. Okay. What is IFRS 7? Ma'am, it's just the disclosures. Why a different standard for disclosure? Students, how easy it looks, it's not that easy also. Yeah, it's not that easy also. So obviously there are certain complications in this standard, so it's not so easy. So it's very good to give a proper clarification about all those stuffs. So there is a requirement of proper disclosures which needs to be given in the financial instruments. Cool. And up next we have the most important thing, which is IFRS 9. So I told you, if I take up any standard, the standards are prepared how? Considering RMPD. That is, we need to recognize, is this satisfying an asset or liability or income or expenditure? If I understood, this is my expenditure, this is my asset. On what value will I do the measurement? So yeah, we have a measurement concept. We have a presentation, because anywhere I just cannot present it because it needs to be, proper format and chronological. And last but not the least, it's a disclosure. So similar way, if I understood, this is my financial asset. Okay, this is my financial liability. This is my equity portion, ma'am. If I recognize it, till what date will I recognize it? And once if it has been not in the position to satisfy the definition, I have to de-recognize it. If I de-recognize it, at what value? Then if I understood the definitions, again I have to go ahead with how will I do the measurements? What will be my measurement criteria? Means at what value will I record it? I don't know. Then we have a concept of impairment. Means with the word impairment you need to know that, ma'am, impairment means, I think like there is a position where I think whatever assets you have recorded, if you sell in the market you will not get that much, right? For example, my carrying amount or my carrying amount of the asset, whatever I have recorded, is not so like in the position that I can get in the market. Means your carrying amount is obviously more than something which you can recover in the market. So it's known as recoverable amount. So yeah, if you know, there is an IS 36 for that, which gives a very clear-cut situation. Means your asset is like, let's say 1 lakh, and if I sell in the market I get only 80k. So definitely there is some losses, which is known as impairment loss. So now even in these financial instruments, we do have a concept of impairment. Yeah, we have, if you remember, the word credit risk. For example, see, that is something which is small. So I'm going on and on right now, okay. So credit risk means, for example, if I am the banker, okay, I'm the bank. For bank, what is the biggest income? Definitely if I give loans to a lot of people, the people will give me, will repay me the loan plus they'll pay me interest. So yeah, that becomes a very beautiful income. Like, yeah, it becomes my income. But what if I say, okay, the people who have taken up the loans, there is a very less probability that they will pay me interest. Or if it's like Nirav Modi, if it's like Vijay Mallya, if they didn't pay, what it is, ma'am, it's the biggest credit risk. So yes, that risk of not getting the assets, it's impairment. Yes. Then we have some general hedging accounting. So yeah, we do have some general hedge accounting also, which people tends to feel very difficult. Yeah, but it's okay, guys. Congratulations, because one of the concept which was very tricky for you people to understand is not there now. That is embedded derivatives. So yeah, they have removed embedded derivatives from our concepts. Okay, so yeah, the definition. So it's a contract which gives rise to both financial asset for one entity and financial liability or equity for another entity. Yeah, so we are so sure with the definitions. Pakka pakka. Now, what's the meaning of financial asset? Financial asset means today it is something like your asset. Means you are going to receive either the cash, either you are going to receive the equity, either you are going to receive some portion of cash, some portion of equity, whatever I am going to receive it from some expare, it's known as financial asset. Financial asset is an asset that could be cash, it can be an equity investments or instruments, or a contractual relationship to receive cash or any other assets from the entity. Clear. Or it's a right which I am having to receive what? Some favorable thing. Okay, cool. Under any favorable position. Or it's a non-derivative contract to receive some variable numbers. So what's that? First of all, these words hits me more. Non-derivative contract. So before I go to non-derivative contract, I need to know the meaning of derivative contract. If you take up the non-derivative contract, it's a normal contract. Normal means a normal contract. I'll just give you one meaning of derivative. So yeah, people will understand derivative from the perspective. It's very hard, it's very difficult. What it is, ma'am? I don't understand. See, for derivative we have a concept. I'll keep it later, but for meanwhile, okay. For example, derivative means you feel like, ma'am, it's something like gambling. No, it's not a gambling. It's legal. Okay, it's the legal terms. So derivatives means the word says derive, derivative. So it derives its value from some underlying asset. For example, if I tell you, what if the price of the milk increases? So yeah, ma'am, if the price of the milk increases, the milks will be costly. But is it so? Do you think can there be any other position like because of the price increase in the milk, will there be any other consequences? Yeah, relevant to that, all the milk products, all the dairy products, all the things, prices will also increase. Yes. So for example, it's butter, cheese, ghee, or it can be any sweets. They are directly relevant on the price of the milk. Yeah. So the butter, the ghee, the cheese is going to derive its value from the underlying asset, which is the milk. So yes, if any of the price increases or the base, considering that if it is impacting something else, it's known as derivative. Yeah. So there is no other derivative, it's a normal contract. But if I have invested in some company, for example the preference shares, and I don't know how many convertible preference shares will be converted into equity, it's variable, it's okay. Still for me it's an asset. Still for me it is a financial asset only. Clear? Because any which ways I am going to get some or the other thing. I will receive something. The same way it goes with the financial liability also. So liability means it's an obligation that the company, the party has to pay cash. Or if I don't have cash, maybe I can give some other financial asset also to you guys. So that means it's a financial liability, means a contractual obligations to deliver cash or any other financial asset to some other entity. Or just give me a minute, I just need to keep my phones at a silent position. I thought like I have put it, but yeah, eventually it's not. Yeah. Then up next over here with the meaning, it's written the contractual obligation. It's an obligation that I have to settle what? Okay, if there is something unfavorable, it's my responsibility to like settle it. Okay, cool that. Or a non-derivative contract to pay the variable number of own shares. Means, example, like I told you, non-derivative, a normal contract, like a convertible debentures. So today I have to pay you so much interest, but maybe I need to pay you some amount of variable equity shares, because today I don't know how much exact equity shares I need to pay. Why it is written? Are Papa, if I know exactly how much equity shares I have to pay you guys, So why will then it comes in financial liability? No ma'am, then it will be returned in the equity portion. Understood? This is the difference. If it's for sure, like okay, 1000 equity shares I'm going to pay you. Are baba, if it's so, then it will come in the equity and not in the financial liability. Yes? Okay, cool. So IS 32 is what, guys? It's just giving us the definitions, like what are the things coming in the financial assets. It's okay, we have already read it. Like financial assets means over here it can be cash, currency, notes, etc., etc. Equity instruments means shares, equity shares. Debt means something like I'm going to receive it, the contractual right to receive cash. Derivative financial instrument means which derives its value from some underlying assets. Assets or liability. Means I get the value from some underlying thing. Simple. Now it's the same thing, it goes on. The financial liability means contractual obligation, you have to pay, unfavorable, and yeah, it's the same thing. The non-derivative, derivative, cool. Okay, then what is equity instrument? Okay, if I ask you the meaning of equity, what it is? Yeah, we know now one thing. The total assets, let's say of my company, let's say 100. Okay, same way over here, my equity is, for example, I don't know, X, but my outside liabilities, for example, 60. So what I can get, ma'am, easy. Assets minus liability is equal to equity portion. So what's that? It's a residual value, whatever is left over. So it needs to be 50, which is equal to net worth also. Like the equity portion, that way. So any contract that evidences a residual interest in the assets after deducting all the liabilities, means assets minus all the liabilities, if I deduct it, I get the equity portion. Yeah. Now what's the meaning of fair value? Okay, ma'am, fair value means today if you have this much asset, okay, I need to know what's the fair value of this calci. Okay, so if I sell it, what will I get? Or if I have to pay 5, like I have to pay to some X party, so if I settle it today itself, what value I will settle it today at the measurement date between all the participants. So that is fair value. So fair value is a price that would be received if I sell an asset today itself, or if I pay the liability today itself between the knowledgeable market participants, and at the measurement date it's my financial, it's my fair value. Okay, then if I'm going ahead with the fair value or financial I'm so sorry, liability, there are certain examples which is given, and we know that we have already covered it. It can be like borrowings, it can be trade payables, obligations, and provisions. Equity means it's some ownership interest, so that we know that is something residual interest of the assets minus all the liabilities. Then we have the compound financial instruments. So if I read the compound financial instruments, so guys, you will not be able to figure it out. No, I don't want to save it. For that, students, I am supposed to just show you one solution. Yeah, just give me 1 minute. Okay, I think like yeah, we have a question from the kit. Like I have taken it to one question. Yeah, please tell me if it is visible. Yeah, it's visible, right? Okay, I'll make it smaller. So please try to understand it. Please try to read it. Okay, please try to read it. Read the question. It's there. What should be done and what should it be accounted? The company is having some X amount. Yeah. So give me 1 minute. Yeah. Yeah, so yeah, we have a lot of questions for this chapter also. Yeah, okay, I think we can read the question. Yeah, it's visible also, clearly visible. Okay, so basically they have written the company issues some, yeah, okay. It's not getting up open, why I don't know. Okay, yeah. Yeah, are you able to see this question clearly? Yeah. Chalo, we can start with this question. The company issues $1 lakh. Yeah, it's visible. Yeah, is it small or not? Cool. The company issues $1 lakh, 4% 3 years convertible loan. So first of all, when I go ahead with the compound situation, which is the compound financial instruments, you get one word very common. Yeah, all the time. You'll get to see the word convertible. When it's convertible means, today if you're having bonds, today if you're having preferential, there is a surety. In future, definitely, some or the other thing, you will get it in the name of what? Yes, in the name of equity. So today there is a position that maybe today you may not get equity, maybe something like later on you may get equity. So at what value will I record it? Like, should I record it at a, like, which price should I record it? Like, ma'am, should I record today as a financial liability or is it an equity? Means, ma'am, future though I'm going to get equity. So that is a doubt, right? So for that now, students, it's very important for me to understand the concept of compound financial instruments, which says that, which clearly says that, see, if I am giving you, if I am the company, if I am giving you instruments, which is convertible, am I giving you an option? Yeah, you are having an option. Is it good? Yeah, obviously, it may be good for you. But if I'm giving you options, am I telling you I will not pay interest? Ma'am, today you are giving debentures, today you are giving preferences, so that the dividend I have to pay, that the interest I have to pay only. But if it is at your choice that you may get in future equity, okay, so we have to give them today also. So some portion today, whatever I have to pay them, like basically it becomes my financial liability, and some portion becomes my equity. Means in case if it is converted, what amount of equity can I write it? Because now the one thing which is very pretty sure is that you will never have a surety if it's at the hand of the holder कि how much equity and when are they going to convert it into equity. So मुझे तो देखो safe रहना है. I want to be safe. So what I can do is I can book a maximum expenses. That's all. I can book my maximum liability to be at a safer position. Yeah. So what I did it. Okay. With this overview, we can just read the question. Yeah. So yeah, there is a company. The company has issued 1 lakh 4%. 3 years convertible loan. 3 years. Okay. So years are given. It's 3 years convertible loan. So holder has converted it what? So I'll just write it. What he has did, students. Just give me a minute. I don't know whether it's being written or not. Yeah. Yeah. So 3 years convertible loan of $1 lakh. Okay. So what I can write it over here? It's basically this. $1 lakh, 3 years convertible loan at the rate of 4% is given. Cool. Okay. And that is given on 1st Jan 20x6. Okay. That is given on 1st Jan 20x6. So I'll write it 1st Jan 2006 only. I'll write it. Will it be fine? Okay, this is on this date. Cool. Yeah. Whatever they have given, I'm just framing it off. Cool. What they have written it. The market rate. Okay. So on 1 Jan 2006, the company has given to some X person 4% means you will get an interest on the loan at the rate of 4%. Today you will get how much interest? Only at the rate of 4%. But it's a convertible thing. So if it's a convertible thing, I'm giving you an option, you can convert it into future. So why will I give you more interest also today? If I didn't give you convertible option, just read it. The market rate of the interest of similar loan without conversion option is 8%. Means if no conversion, if I'm not giving you any conversion option, then I'll give you 8%. Okay. So without conversion option, it's 8%. If I'm giving you conversion option, it's basically 4% only. Cool. The conversion terms are 1 equity share. Okay, so conversion way, if it's getting converted, I will give you 1 equity share for how much? For every $2 debt. So whatever is my total debt, if I'm having $2 debt, I'll give you one equity share of $1 each. Can I take like 2:1? Yeah, like that way. So what they've given, conversion redemption at pay or par takes basically on 31st December 20x8. So 20x6, 2006, 2007, 2008. So basically it's 3 years. Yeah, what they have written, it's 3 years. Okay. So on 3 years, there is a situation that over here, at the end of 3 years it can either be redeemed. Yeah, it can be either redeemed or like it can be a position. Redeem means they don't want to get converted. Maybe they want to get it redeemed, they want cash as in when, or they want to convert it into equity. So what have they given us? How should we account for if all the holders elect for conversion? Acha means all want to convert it into equity shares. So when it is a stuff, when it's a convertible thing, definitely baba CF, compound financial instrument, comes into picture, CFI. Okay, now considering that into view, let's go ahead with the first option, that is the holder elects to convert, means the holder wants to get converted into equity shares. So before that, what are the things which I'm having over here? It's basically first thing which you have to find it is the compound financial instruments. So how many dollars you all are having, guys? So we are having, ma'am, $1 lakh for 3 years convertible, and this is my interest which I have to give. So can you tell me how much interest I would have paid, ma'am? I would have paid an interest of how much? 1 lakh into 4%. Yeah. So yes, sure. So ma'am, I would have paid an interest of 4,000 for sure. Till you anybody doubts? No doubts, ma'am. It's very clear. Up next, if it's without conversion, ma'am, how much interest I would have got without conversion? Can you see this question? Yeah, ma'am, without conversion it's 8%. Oh my god. So if it's without conversion, guys, I would have got 8%. Means if you didn't had an option to get converted, you would have got 8,000 as an interest, but now you're getting only 4,000. No worries. And this is redeemed after how many? After, let's say for example, after 3 years. So when I take the compound financial instruments, my responsibility is to do what, on the day one. On the day one, I have to think, what if it's not converted, then what is your present value of liability? What's your present value of liability? Please figure it out. That today, if it's not converted, what is the maximum liability you're going to get it? You have to pay it. Okay. So I have to make my own stuff over here. That is, yeah, year 1, year 2, year 3. So over here, I have to make the payments. How much payment I'll do every time? Okay, ma'am, I have to make some payments at the rate of 4%. It's not 8%. But guys, I'll tell you, year 1, year 2, year 3. So if it is not converted, company will pay how much first year? Ma'am, first year they'll pay interest of 4,000. Second year also they'll pay interest of 4,000. Third year will pay interest plus the redemption amount of 1 lakh. Okay. So ma'am, you will say, ma'am, this much is the payments. Yeah, this much is the payments. So what do you think, ma'am? This much becomes a liability. Can I book like this liability 112,000? Yeah, this is my liability. No. This is not your liability. This is something you total. But there is a function which is known as the discounting factor. So ma'am, what is the discounting factor? What if I say you 8%? What if I say you 8%? Why 8%? Guys, without conversion, how much are you getting it, ma'am? 8%. So please consider 8% and book that way. Okay, so if it is 8% as a situation, what do I feel? Okay, what will be my liability? What will be my present value of liability? Divided by 8. Yeah, now 40,000 divided by 1.08. Again divide by 1.08. One time, two time, ma'am. Here, ma'am, 3 times. 08, it's not only 8. Please don't make mistake over here. So if I take up the sum, it will be something lesser than that, yeah? Cool. So today, can you tell me what is your liability? Ma'am, my present liability is 89,692. So this is my liability component. It's my liability component. So what did you got on day 1? Okay, is this a liability component? What did you receive on day 1? So initially on day 1, so I would have received this amount, like 1 lakh convertible. So people would have invested that much, 1 lakh. Yeah. So people would have invested 1 lakh for sure. This much people would have invested. So this is my initial receipt, or whatever the initial thing on the day of the issue. So initial on the day of issue, I would have got this much. So what is the equity part in that? So ma'am, you have to see, 1 lakh is something on the day when you're getting it, and in return of that you have to book this much as a liability. So yes, this portion becomes my equity. What's so big? Okay, yeah, there is a lot of Happens. So now this becomes my equity portion. Means, what did you got it on day one, guys? What did you got it on day one? Think, ma'am. On day one, I received how much? So I'll say, ma'am, on day one, I received 1 lakh. On day one, I received 1 lakh. So if I receive 1 lakh on day one, if I receive 1 lakh on day one, I have to book out of this 1 lakh. Okay, I'll come it over here. What I received on day one, guys. On day one, if I received 1 lakh, and I was being told that out of this now we have, it's a convertible thing, so some portion I have to book equity, some portion I have to book liability. So liability means, ma'am, simply do nothing, book a present value of liability, and whatever is the difference, it's nothing other than the equity portion. Yes, so that is known as the compound financial instruments. Yeah, I hope you guys are getting it. Yes, but ma'am, that will not be enough. If I make this much, it will not be enough for me. I have to make something more. So what it is more is, I tend to know, okay ma'am, if I'm booking like this, the liability, this is the liability, will I get at the year end 0? Because we know we have to complete the liability, we have to make that my favorite part, you know, that opening, ma'am, your opening interest you're getting it, payments you're making it, and the closing liability. Yes. So if it's this, guys, what's my opening situation? What's my opening liability? So ma'am, it's presented in the question, right? Yeah, it's there. So ma'am, for year 1, there are 3 years, right? 2 with 3. On year 1, my liability turns around to be this much, 89,692. On that, ma'am, 8% interest will have to pay, like that will be my expense. Actually, every year, what is the company going to pay? Ma'am, we are going to pay 4,000 interest. Yeah, the company is going to pay 4,000 as an interest. It's for sure. The company is going to pay 4,000 as an interest. So this becomes my closing liability. Clear? My closing liability needs to be my opening liability for the next year, for sure. Now this becomes my opening liability. Again on that, Baba, I have to pay interest of 8%. Again for the payment is this. If I take up the total, I'll get this. Sure. Up next, my second year's position becomes my third year's position. Yeah. Again, what you'll get it. Okay, ma'am. On that, I have to make this much. On that, again, 8% interest. And last, how much payment will I make, guys? I'll make the payment of 1,04,000. Please take the total. You'll get somewhere around 0 only. Cool? Is it cool? Is it fine? Is it understandable? Yes or no? Yeah, students, it's very simple. It's very simple. But just we need to understand how it is going ahead. Okay? How it is going ahead. Understood. Now looking at these, what I feel, if it's getting converted, you remember? There is a question. Okay, so this is the highest concept that we need to know in the compound financial instruments. Means, whatever I'm receiving it today, in front of that, what am I paying in the name of equity? Like equity, how much I'm booking it, and what is my maximum financial liability? I have to book that. Yeah, very simple. Up next, we need to know, we are very much obliged to know that, after completing that, is there anything else they have asked us in the question? Yes, if they want to get converted, what will they get? For every $2 of the debt they have, they get 1 equity share. What is the liability? What is the debt the company has? Yeah. What's the liability, ma'am? On the day 1, it looks like 1 lakh as a liability. Like, what is my liability on the day 1? Ma'am, it's 1 lakh, right? Cool. Your liability is $1 lakh. So I can write it like that. For conversion, for conversion purpose, my liability is 1 lakh. Yeah, ma'am, my liability is 1 lakh. 1 lakh bonds, $1 lakh. Guys, if it's $1 lakh, how much equity can it be converted into? So it was written, for every $2, pay $1. Yeah, you remember? For every $2 of liability, we need to give $1 equity. So over here, for every $1 lakhs, how much equity I'll give, ma'am? Obviously half. So 50,000 equities will I issue. So for me, it will be like 50,000 things I will issue. So 50,000 things I will issue 50,000, because in the question it is given, for every $2 we have to give 1 equity shares. So clear? So ma'am, this much is my equity number of shares which I have to pay. Clear? Yeah. But what do you think? Only this much will be my equity shares or what? 50,000, that's all? No, one more thing ma'am. Normal this equity portion also we have. Yeah, so we have this equity portion also. So yeah, this is my equity portion which I have to book it. So my equity is 10,308. So my equity is 10,308. So even that will be my equity shares. So मुझे वो भी तो पे करना पड़ेगा. I have to pay that also. So if I take up a total, my total equity shares will be 6,308. I hope you guys are getting it. Yes. So students, it's very simple. Day one, what's my liability? If it's getting converted into equity, what amount of equity shares I'm getting it? And after compound interest, what amount of equity I have to issue more? That's all. I hope you guys are getting it. Yes. Okay. So this is the very beautiful concept of compound financial instruments. I hope you understood it. If you didn't got it, students, you have this channel where you can go back and see it in 1.5 speed, and yeah, you can get it more clear. So I'm not going on revising it on and on because hardly we have a lot of concepts to be done. Yeah, we have a lot of concepts to be done. For sure, we have a lot of concepts. Yeah. Is it the PPT visible? Yeah, just give me a second, Baba. For me, it's visible. I don't know for you guys, it's visible or not. Yeah, it's visible, isn't it? Yeah. So what have we initially covered? We have covered a lot of concepts for sure. Now we will be going ahead Weasley. So yeah, all the stuffs we have covered, ma'am. We have covered the compound financial instruments also. Yeah. Now with these guys, a lot of concepts of IS 32 is over. So yes, students, with these we have completed IS 32 for sure. So I've covered a lot of concepts of IS 32 where we could make the difference between what is financial liability, what is equity, and what is all those stuffs. Okay. Now we are at a position where we are going to learn the most important topic. Yeah. So where are we basically? Yeah. Okay. So students, just give me a minute. Also checking up the chats, so on and on. So yeah, it was perfect. So yes, students, now we are at a position to learn the most important topic, which is IFRS 9, that is financial instruments. I expect students this financial instruments question to always come up in the section A. Question number 1s, maybe B or C exhibit. You can find some questions from the financial instruments also, where we know that IS 32 was relevant about understanding what is financial asset, financial liability and equity. But today, if I understood, okay, these are the definitions, what will I measure, where will I classify it, is understood in this IFRS 9. So yes, students, if I want to have a proper classification, if I have to want a proper classification of the financial asset and liabilities, we have a concept which is known as IFRS 9, which shows me up a proper classification of first the financial asset. So when I talk to you about asset now, students, it is going to classify asset into 3 parts. You would have heard this word. Yes, amortized cost. So amortization, I can write it, amortized cost, fair value through OCI, fair value through P&L. There is fair value through other comprehensive income and fair value through P&L account. Okay. So these are the three methods in which I can classify my financial assets. Up next, if I say about my financial liability, even for that, Baba, even for that, I have some classifications to be done about my financial liability. But yes, it's a good news that we don't have so much of like different two, three things. No, no, no. If it's a financial liability, definitely, if I'm year over year, if I want to go ahead, I can just show you for once. For financial asset, guys, I have three parts. But for financial liability, it's just restricted to two parts over here. I can go ahead with amortization and FVTPL. We don't have a concept of OCI, no OCI in this. So yes, students, this is just one base which we need to know. Okay, now how will I understand, how will I go ahead with this financial instruments? Okay, the classification. So before I go ahead with the financial liability, my first agenda is to understand the concept of financial assets. Okay, my first agenda is to understand the concept of financial assets. Okay, so if I want to classify the financial assets, so first when I take up this things classification, before understanding classification, it is any business, I need to know the business model. If the company's business model, if the company of the entity, my company, my business model is to, for example, it's a financial asset. So maybe I'm going to receive something, receive. Try to understand it very easily. If my financial, okay, I'll make it one more slide. So yeah, it will be very easy. Just students, please try to understand. When I'm doing the, okay, first of all, classification of financial assets, which is bifurcated into three parts. So how will I get the bifurcation? So understand that these are certain tips and tricks which we need to know. First, identify what is the entity's business model. Business model means what is the entity going to do? What is the entity's expectations? How is the entity running? What the entity wants. If it's financial asset, it wants some or the other thing. Like, and what they want is nothing other than the contractual cash flows. So what are the company's contractual cash flows? Means something what they want, inflow. Cash flow means inflow. What are the contractual inflows which the company wants? Okay. What if I say you very simple. As I told you, it's going to bifurcate into three parts. First is amortization. If I say you, I am the company, and I have invested where? I have invested in the bonds, of XYZ company. Okay, just keep that in view. If my company has invested in the bonds of XYZ company, and if I am the person who is very simple, my entity is very simple, we don't want to enter into the stuff of getting things changed on and on. Like, I'm very much like sorted person. Like, I am just interested. Like, if I have invested in bonds, I will get interest, and at the end of maturity, I will get the matured amount or the redemption amount. Means, am I interested in getting the fluctuations at the relevant year end with the fair value? No, ma'am, I am least interested. I am a very simple person with the expectation of only getting interest, and at the end I am getting only the principal amount. Means, in amortization, I am very simple. I am very sorted. It's very like lame thing to explain, but yeah, it's similar. Means, where my intentions of my company are to hold the asset, and to receive what? Hold till what? Hold till maturity. To receive what, guys? To receive what? To receive interest, and at the year end, principal amount. Means, in between, at any year end, if there is any fluctuation in the market, getting the rates on high, low for the bonds, I am least interested. I don't want to sell it. I want to keep it. Like, I have other work also, so I'll just invest it in the bonds and I'll forget it about the bonds. Yeah. So that is known as amortization. Moving ahead, we are at the concept of FVT OCI, fair value through other comprehensive income. So what is fair value through other comprehensive income? Means you are very good. The company is very much serious with whatever other works they are. But if they have some spare amount, they would have invested in the bonds. Intentions are also to keep it till maturity. But they take a chance. If in the market, if the value increases beyond, they may sell it before maturity. Means my business model is simple. I want to hold it till maturity. Plus, if I get a good option, I can sell it also. Means you want to hold it for a period till maturity, but in case if you get a good market, you can sell it also. So yes, means definitely, I'll definitely get interest if I hold it. Plus, if I'll get the principal also. But if I sell it in between, I can get some gain. I can get some profits. Yeah. If my intentions are clearly to get only interest and here in principle, it's amortization. But if your intentions are maybe if something in the market is good, you can sell it also and gain profit. And if you can gain profit, then it's basically as per FVT OCI. Okay. So what's OCI, ma'am? We have to book year-end changes. If there is a gain, where will the gain go? Where will the gain go? Yes, ma'am, it will go in OCI. Every year-end I have to measure. I have to re-measure things. That is known as FVT OCI, fair value changes through other comprehensive income. Last but not the least topic is FVT PL, which people misinterpreted. So fair value through PL account means your intentions, your company is engaged in daily trading. Ma'am, today value is more, purchase the bond, sell the bonds, purchase the bond. Arey means what, baba? You want to hold the asset till maturity? No. I am into trading. I'm into trading of those stuffs. If I'm into trading of the stuffs, definitely students, everything which gets changed, where it will go? Where it will go? Any changes, daily fluctuations. Ma'am, it's daily fluctuation. Yeah, my spellings are very wrong. Yeah, my daily fluctuations. Oh my god, I don't know the spelling of fluctuation also. My students knows that. I'm very bad. So daily changes, for example. Yeah, if there are daily changes, so where it will go? Ma'am, it will directly go into P&L stuff. Means, do you want to hold it? No. Do you want to like retain it? No. Will you get interest? Arey ma'am, daily if I'm selling and purchasing it, what amount? I don't know. What will I get? So yes. So these are the classifications of financial assets. This are the classification of financial assets. Means it's very important to know, Baba. It's very important for us to have a glance. Just give me a minute. I'll just... Yeah. Just give me a minute. I'm having a chat. Okay. 270. Okay. Yeah. So students, see, so I'm telling you students, this becomes the most important point which we need to know. And okay, this is something which I explain it in my class to my students. It's something like a story. If I am having an asset, for example, okay, if I am having my boyfriend, okay, this is a disclaimer, this should not go beyond the class for sure. Okay, if I'm having a boyfriend for sure, and if I am planning to get married to him only, like I'm very sure, like I want to get married to him, like actually it's my love marriage, so obviously I thought like I'll get married to him only. Okay, so if I'm very serious about him, I don't have anything else, I'm just interested in him, and my expectations in the last is to get married. So like I'm very simple sorted person. So am I interested anything with the fair value in the market? Am I interested in any other boy in the market? No, not at all, not at all. So yes, if I'm not interested in anything else, it's my amortization. I have to book as per amortization that my asset is. Yes. But for example, if I'm having my boyfriend, means I want to keep it till long, like I want to hold him. But in case if my parents are also figuring it out for some other boy to get married, and if I get a better option, I may switch. Then yes, I am interested into fair value of the market. I am interested to know. So that is known as fair value through other comprehensive income. So I have to check it. Last but not the least, if I don't have boyfriend, and if I am figuring it out for the boys, any profit, any loss, it will be P&L account. I know it was very lame, but yes, if you understand these concepts, it will be very easy to solve the questions. So yeah, I really want that it should not be a meme for the class for sure. Yeah, cool. Yeah, Okay, this is my financial asset and this is what I have went through it. Okay, the most important, like the liner, if I said it, like it's a small glance, just for like 2 minutes I just explained you. Yeah, so I think like it's very clearly understandable if I'm having any financial asset. Yeah, if I want to hold it for long, it's amortization. If I may sell it, may changes in OCI. If I want, like if I'm interested into selling purchasing directly in P&L account, least concern. So ma'am, if I want to enter into any financial asset, will I be having any other expenses? Yeah, why not? Maybe you can have some other transactional cost. And if I'm having any transaction cost, what it should be? For example, to enter into a bond, I have to pay the documentation fees, etc., etc. So students, if it's a transaction cost, it needs to be added. It needs to be added. Cool? Okay, it needs to be added. It needs to be added. Okay, just give me a minute. Yeah. Just a minute, huh? I hope you guys are getting it. Yeah, is it not so difficult, na? Yeah. It's easy. It's not like something which we just cannot manage it. Okay, yeah, it's very simple. And yeah, this becomes one of my favorite topic also. So yeah, financial instrument is my like very next to heart. Yeah. Up next, we have another concept which is known as financial liability. So ma'am, in the financial assets, is it something like the same thing in the financial liability? Yes, a lot of concepts are same, but there is only one change. So when I do the classification of financial liability, my financial liability is bifurcated not in 3 parts, it's just in 2 parts. 2 parts means I'm over here, I'll be having amortization and I'll be having it over here, fair value through P&L account. Means if like I have issued the bonds, try to understand, if I have issued the bonds, I have to pay interest, yes ma'am. I have to pay the principal amount, yes ma'am. So this is obviously I have to pay. So that is known as amortization. Okay, but if I am into daily transactions, that is known as FAT, PL. Okay, and in this, if I am having any transaction cost, students please take care, transaction cost needs to be deducted. Okay, now we can read the theory, which is very easy. So yeah, my first model over here turns around to be what? Okay, there are 3 models to be recognized in the financial asset. Okay, in the financial asset it's 3 models. First, hold to collect means only you are keeping it to collect what? Collect the interest plus maybe end May you will be collecting the principal. That means the entity's business model is to hold the financial asset to collect the contractual cash flows, and those cash flows represents solely the payments of interest and principal. Yeah, the financial assets are classified at amortized cost. Yes, it's considered at amortized cost, where I'm not at all interested with what the hell the fair value is. I don't care. Okay. Then second point is FPT OCI. OCI means any changes you want to book it through other comprehensive income. So what it is? For example, you want to hold it, plus if you want you can sell it also. Means your intentions are to hold the financial asset, plus to get also cash flows, plus if you want you can sell the asset also. And if there is any changes in the market value, you can put it directly, not in P&L account, any gains and losses, you can put directly into the OCI. In these now students, there is one exception that I will explain you. Like in the OCI now students, for example, I was on and on speaking up, but you remember that I'll be getting interest, I'll be getting principal, etc. What if the company has invested in equity shares? Ma'am, if the company has invested in equity shares, what will they get? Will they definitely get dividend? Not sure, ma'am. The contractual cash flows are not sure. Then amortization will not come because they will not get for sure. Ma'am, OCI. So then they told P&L account opens everywhere. P&L account says if there is any changes, come to me. P&L account is going to accept it. So I'll say no, I don't want to go with P&L account. Why? I don't want to pay taxes on P&L account. It's not my income. Then it's an exception. Means if you want, you can choose to record investments in equity, where guys, investments in equity, when directly any changes through fair value through OCI, or if you want FVTPL. But if you're not choosing FVTPL, if you're choosing OCI, it is disclaimer, it is an irrevocable option. Means once you chose to show in OCI, you have to show it in OCI. Means for time being, ma'am, I don't want to pay tax. Next year I want to pay tax, ma'am. Profits, loss, no. If it's OCI, it needs to be OCI. That way. Clear? Easy. I know I make these concepts easy. My students love this concept from my side. I know, and I'm pretty sure. Yeah. So yeah, what's fair value? P&L account. Okay, if my intentions are to gain profits, not to keep it. Okay, I don't want to hold it. If the entity's model is to hold the financial asset for what? Means you have purchased the asset for the perspective of only selling it, for the purpose of selling and realizing gain. So any change directly, please book it in P&L account, because daily you will be doing what? Transaction, sale, purchase. So anything in the P&L account. Now, if it's the financial asset, I told you any type of transactional cost is to be done what? So any transaction cost are to be plus transaction cost. Means at day one, when I record the financial asset, I have to add any transaction cost, means it's added so that I get the value. So this transaction cost, if it's amortized cost, then where it is going to add it? Ma'am, like, should I add it in the cost of an asset? Or like, for that also I'll show you one very beautiful thing. Yeah. Okay. Try to understand it. If it's a financial asset, okay, it's a financial asset. And that is also classified into three parts. Yeah, we know. And first is amortized cost. Then FVT, OCI and FVTPL. Okay, cool. If it's amortized cost, means what are we doing, ma'am? Are we interested in anything in P&L account? No. Amortized means your intentions are to hold only. So everything is your asset. So if it's your asset, you will be having that financial asset in your financial position. At the time of asset only you will record it. And if there is any transaction cost, you are going to add it in the cost of an asset plus the transaction cost. So over here in amortized cost, you will add it directly to the cost of an asset only. Similarly, if there is any transactional cost incurred for OCI, ma'am, even that is an asset only. Which I want to record. It means my financial asset only. So it's an asset. Which is said in the P&L account. Which is said in the financial position. So do you have any scope of P&L account in this? No, ma'am, no scope. So even for that, cost of an asset, I have to add the transaction cost, and that's all. But if it's P&L account, any changes through P&L account, just imagine your day-to-day work is to sale purchase. So how much transaction cost it will be? Yes, ma'am. If I'm having a transaction cost for my FVTPL, let it go ahead and put the transaction cost into my P&L expenditure. Please take this consideration a very high way. Over here, if it's amortized cost, it's added to the cost of an asset. If it's OCI, added to the cost of an asset. But if it is P&L, added to P&L as an expenditure. Yes. This is also very important about the transaction cost. But obviously, if it's a financial asset, definitely it is added, okay? But if it is a financial liability, then what? Students, if it's a financial liability, for sure, there are only two parts, ma'am. First of all, it's amortized, and another one is fair value through P&L account. And then what to be done? Okay. Ma'am, if it's a financial liability, please deduct the expenses. Deduct the expenses from P&L if it is FVT P&L. And if it's amortized cost, you get a cost of an asset or investments minus the transaction cost. So yeah, students, only these two is a part where a lot of students get confused. And they make things wrong in the examination. So yes, students, I want you all to know these concepts thoroughly. Yeah? Is it clear? I hope we are done with this. Yeah? Clear? Very clear? Okay. So if you read it, it is one and the same. It's one and the same. So I told you about equity. If I have equity investments, So if it's equity, definitely. If it's about cash flows, will I get dividend? Sure. No ma'am, not sure. So amortization will not come. There are only two parts, PL or OCI. PL, it's always acceptable, you can put it, but if I don't want to go in PL account, if you want to stay, if you want to say, no ma'am, I am not interested because I am not doing the daily tradings, so why will I put in PNL account? I don't want to put in PNL account. Then ma'am, it's okay, you can put directly into OCI account also. So yeah, if I put directly into OCI account, that shows that it's not for trade and it's an irrevocable option. Like once OCI, always OCI. Yeah, that way. Yeah, cool. Yeah, so there are something which is return on and on. It's the same thing which I have taken up in the class. So yeah, there are a lot of things. Yeah, it's important. It's important. Now you can take up this. It's a debt, means investment in debt, means investments in bonds. Yeah, just give me a minute. Yeah, wait a minute. Now students, this becomes the very important short summary analysis, which is investment in debts means investment in bonds, investment in debentures, yeah, investment in any such things where the entity is going to get what, guys? Yeah, I'm going to receive the interest for howsoever years I have kept it, and at the end of the period, end of maturity, I normally get what? The principal amount. Yeah, the principal amount. Yeah, cool, very cool. So I know if it's a financial asset, it is going to bifurcate into three parts. Three parts, that is amortized cost, fair value through OCI, fair value through P&L account. You know, I have explained you very well. If it's amortized cost, what am I thinking? Ma'am, I should every year get interest and I should get at the year end the principal amount because I want to hold it. Yeah. So over here, my business model is to hold it and my contractual cash is to receive interest plus principal. Yeah. What about FVT OCI? Ma'am, you want to hold it. Sure, you want to hold it. But if you get something better in the market, you can sell it also. So you want interest plus principal plus you want gains. If you get a better market, you can sell it. Like, yeah, I was figuring it out from a boy. Like I was having a boyfriend, but still, again, you know that I was searching it off. Yeah, that way. So I can get a better opportunity, I can sell it off. But last but not the least is FVTPL, means, yes students, PNLs means daily you are engaged in this stuff where you don't want to hold it. Means my intentions are to sell it only and gain profits. So daily anything if I'm doing it, it goes in PNL account. Means it's not measured as per amortize and all, because it is totally measured as per PNL account. Where your intentions are just to get gains. So any sort of gains and losses at the fair value, you figure it out, needs to be booked in PNL account. In OCI, any types of figure like gains and losses to be booked in OCI. So I hope, guys, this is the most easiest part you would have felt and you would have understood it very well. Yes? Okay. Up next we have one question, yeah, which we can do it. Like give me just 1 minute. I have also framed this question for us. So yeah, okay, just a minute more. That's Hoi company, na, basically, yeah. Yeah. It will hardly take a minute to open the Excel. Yeah, instead of reading this, guys, instead of reading it from the PPT, yeah, I can just close it. I don't want to save it right now. Oh, I would have saved it, even that would have been fine, but it's okay. I've just opened up the Excel. Yeah, the same question. Like I have taken it up from the material. Yeah, and right, yeah, even that is going to clear a lot of concepts. Lot of means lot of concepts. So whatever concepts we learned it right now, it will be very helpful if we do this question also practically, like how it comes. Theoretically, I hope you have definitely understood it about it. Yeah, yeah. So without any further delay, let's just understand it. So if you can see over here, it's a big question, huh? It's not so small question. It's great question. Yeah. Yeah, and students, for these now I'm not going to run fast. We'll be doing it slowly, steadily, because uh, everything is important in this. So what have they first asked us in the question? Illustrate and explain how these financial instruments should be accounted for each company. So maybe there are some 2-3 companies. So in this now there are 3 companies. There is Hoy company, there is Virgin's company, and there is some Cavendish company. Okay, so there are 3. So what we'll do, we'll go it slowly and gradually. So yeah, the year ends on 31st December. Yeah, that is something which is common. 31st December year ends. What's the first thing they have given? The Hoy has raised, basically the company has raised the finance on 1st Jan 20x1 by issue of 2 years 2% bond. Okay, go very slow, very slow. Means the company is going to give how much? Okay, the company has issued some 2 years 2% bonds. 2 years 2% bond. Okay, the company has issued 2% bond. That's fine. 2 years. It was issued at a discount of 5%. Okay, so you are issuing it 2%. Means how much you're going to pay them, guys? How much are you going to pay them? Yeah, definitely 2% you will be paying them for sure. And along with that, you have issued it a discount of 5%. Okay, day 1, I'm just writing it. Day 1, I have issued it 10,000 minus discount of 5%. Cool. So day 1 I have issued at that X amount. Okay, I am going to redeem at this amount, redeem at a premium of this. Okay, so maybe I'll be redeeming it at how much? Some normal amount of 10,000 on which I purchased it, plus I have to pay them the premium. So maybe 1075. So definitely I'll be paying them 11075. Are you getting it? And day 1, 10,000 minus 5%, it's 9500. You would have issued at 9500. You would have issued at 9500 and you would have redeemed at 11075. That's cool. And every year you pay an interest of 2% for 2 years. Okay. Issue cost can be ignored and the effective rate of interest is 10%. Means the discounting rate is 10%. So I'll just copy whatever the stuff I have written it over here. Yeah. Okay. And yeah, we'll start writing the first question, which is basically known as solution for Hoy. There is a first solution for Hoy. Okay. So what's the solution for Hoy they have given us? See, it's very simple, students. Try to understand it. I'm not going very fast. First, what is the date of issue? Okay, how much you have issued it? So students, I have issued at what amount? Issued at 10,000, okay, dollars minus discount of 5%. Discount of 5%. So what are you getting it, students? Please do it. 10,000 minus 5%. Are you getting 9,500? Yeah, so this is your issue. Then ma'am, what is my redemption? Okay, my redemption is basically the issue thing issued plus the premium. So what is they have issued, ma'am? They have issued it 10,000 plus the premium was like 1075 and something like that. It was what it was. I just need to see the question again, I think. Just give me a minute. Yeah, so yeah, my issue was 1075. Yeah, so definitely it was like 10,000 plus 1075. So it comes up to be this much as a redemption. Yeah, cool. What is the discounting factor they have given? Acha, ma'am. They have given the discounting factor at the rate of 10%, and they have told that your interest every year you have to pay 2%. Yeah, how many years, guys? 2 years. Is everything whatever framed in the question, have I formulated it in the notes? Yeah, you have to do it. And maybe in the question, what you can do it, you can just like try to write these things in the sentence, in the statement. Okay, in the statement you have to write it, so it looks beautiful. Okay, like that. Please don't like things, you don't make all this stuff like that way only, so that your examiner feels like half things you have done it. If it's you're going to present, like if it's a discounting factor of 10%, write it properly. Okay, considering the discounting factor of 10%, paying up the interest of 2% every year for 2 years, etc, etc, that way. Yeah, now what to be done? The most favorite thing. Can you tell me what will be the first day's accounting entry if you have issued at 9500? Guys, if I have issued at 9500 means if the company has issued for 9500, what the company is going to get it? Will the company get something X amount, or they have to pay? Yes, ma'am. If I am the company, I am Hoy company, if I have issued, I'll get cash, isn't it? So day one, I'll get what, guys? I'll get on the first year's post day, I'll get cash. On day one, I'll get what, guys? I'll get cash. So cash account debit. 2, what, guys? Is it my liability? Yes, ma'am, it's my liability. It's my financial liability, right? Because I have to make the payments. Payments to whom? Payments to the one who has issued. So first, yeah, ma'am, I'm getting 9500. I'm getting 9500. So what will I do it over here? You know my favorite thing to be done? Yes. Ma'am, you have to remove it like every year. Year 1, yeah, year 1, year 2. No, sorry, I'm having how many years? Only years 2, right? So yeah, this is my opening liability. On that, every year I have to pay interest. Interest at the rate of how much? Remember, 10% is the discounting factor, yeah. So interest at the rate of 10%. Then how much is my actual payments? Yeah, ma'am, my actual payments, actual interest plus principal payment. And yeah, obviously my closing liability. Cool? Yeah. Can we go ahead? Yes, ma'am. For the first, what is my opening liability? Right now I got it, yeah. This is my opening liability on which I issued. So yeah, 9500 is my opening liability. On that, you have to pay interest. Interest is on expenditure that you have to do it. Yeah. So 10% interest expenditure if I do it. How much do I get? 950. So 950, ma'am, I have to book an expenditure. So at the year end, first year's end, I have to book an expenditure like interest account debit to liability you have to increase. To finance liability you have to increase. To liability bonds, or I can just write like finance liability. It can be any which ways. So I can do. And this is going to come in your P&L account. Third, what I have to do it at the year end? Ma'am, you have to reduce your liability by paying the cash. How much will I pay cash, guys? 200. How? Ma'am, what's your amount? Issue amount. Issue amount is 10,000. And 20%, 2% interest I have to give. So this much is minus 200. So as you get the closing liability of this. Clear? Pakka clear? This is the first and the foremost thing I have to do it for the first year, and I think the first year is pretty over. Afterwards, my closing liability becomes my opening liability. On that again, I have to pay 10%. So why not pay 10%? Pass the same entry like 1025 for 1025. Interest expense account debit to the liability or the liability bonds, whatever it is. So I'll pass it like that way. 2 liabilities. So maybe I can write to finance liability. Yeah, whatever, guys, you can write it. Yeah. Then, ma'am, again I have to make the payments. How much payment will I make? How much payment will I make? It's only 200. No, ma'am, it's the last year. So please pay the whole redeem value, yeah, redemption value. Yes. So what's the redemption value? Ma'am, I got it over here, minus 110. Yes. So if we take up the closing liability, my liability turns around to be 0 only. Oh. Okay, what? Oh, I'm so sorry. I made one mistake. Yeah. And this is something you have to make the redemption. But what about interest? Yeah, I forgot. Minus interest also I have to pay. So yeah, it's 0. Yes. So can I copy the entry? Yeah, my last accounting entry needs to be liability account debit to cash, which I have to pay and get my things done easily. That's all. That's all clear? So beautifully we just completed the first portion, the first part of the question, right? I hope you guys are getting it. Yeah, we are not running fast. Yeah, let me drink water and then we can go ahead. So this becomes my favorite chapter. I'm telling you, students, this is my favorite standard. Like, I have a heart in this standard. This, then over here IS 19, for me IS 12. Oh my god, and consolidation for sure. It's for sure. Going ahead. Chalo. Let's move to the second question. So the first question is almost done. Now what about the second question? What are the returners? Try to understand. The company, I'll mark it with different colors, so maybe you will be visibling it easily. Yeah. So the wings, this company raised finance by issuing $20,000, 6%, 4 years loan notes on 1st Jan 20 Expo. So a lot of stuffs are given, right? So what they have given, okay, so yeah, we can just write it like they have given up for 4 years situation. They have given up like 6% loan you have to give, and the valuation is 20,000. Okay, So 4%, I'll write it wings to basically 4 years loan, 6% thing, and the valuation is 20,000. Can I write it like that? Yeah. Wings 4 years, 6%, and interest we have to pay on 20,000. Cool. What up next? On 1st Jan 20 Expo. Cool. The loan notes were issued at a discount of 10%, were issued at a discount and will be redeemed after 4 years. After 4 years, 4 years ke baad you have to add it how much? 1015 premium. On what? The issue cost was 1000. Cool. The issue cost is also given. Oh. Issue cost. Cost of an asset. So, what is the situation on day 1? So, if we see, ma'am, day 1 was this 20,000. Ma'am, you have to give a discount of 10% on day 1. So, please write it on day 1. So, issue date. On the date of on the day 1, that is basically on the date of issue, my cost was 20,000. You remember I have to pay some discounts also. So, I am getting a discount of the rate of how much, guys? Discount at the rate of 10%. If I am getting discount at the rate of 10% is what? How much? So, okay. So, I'll just write it minus 10%. So, I'll get something around 18,000. Yeah. Do you remember? There is a transaction cost. When transaction cost of 1,000 was given on the day 1, you know, we added to the cost of the asset. Yes. But is it a liability? Now that is the most important thing. The company is issuing. That's the reason I told you clearly. The company has raised finance. The company has not invested. The company has raised finance. Raised means they want money. It's a super reduction, guys. It's a super reduction. Always remember the transaction costs are deducted. So yeah, here people can make mistake because transaction cost in the liability is to be deducted. It's not added. Please take these things into consideration, because in the question it is given issue cost is this and the discounting factor is given 12%. Cool. The discounting factor is given 12%. Yeah. The discounting factor is given 12% and the redemption amount is given 1015. Okay, the redemption is given 1015. Okay, we can figure it out for that also. So why do I write all those stuffs, you know? Because now I don't need to go ahead with the questions and like find it out things on and on. So yeah, this is my year end redemption. So what's my redemption, guys? First of all, opening balance. On that you have to pay premium also. Okay, premium of how much we are supposed to pay, there was given in the question of 1015. So 1015. So obviously I have to pay how much? Yeah, this much is my redemption. Very simple, no doubts. Then ma'am, it's the same thing which we have to do. We have to calculate a year, we have to calculate the opening balance, interest, payments, and my closing liability. For how many years they have given? If you remember, the year were 4 years. Yeah, 4 years, 6% and 20,000 to be paid. 4 years, 6%. I have to pay 6%. 6% is not my discounting factor. 6% is my interest I have to pay, and discounting factor is 12%. So please don't get confused. This payment is to be made 6% and discounting factor is 12%. Okay, let's go ahead with the 4 years. Year 1, year 2, year 3, year 4. Students, if you want to make it very easy, I'll give you one hint. Please follow this hint so that you will never make mistakes. Opening, always take this, okay, transaction or whatever you want to take it. Opening, you take it. Then do what you know without fail. Mark all this minus. What's that? Ma'am, payment of day 1, what you are getting it, ma'am, 20,000 into 6%. So every year na minus 1200. Oh, I'm so sorry, minus 1200, and copy this as it is for 4 years. But ma'am, at the end you are gaining something more as a redemption amount also. So I minus this 201. Did I made this? Now nothing to be made. Now very simple. Add interest on that 12% and put on the formula. See, this is what my students do in the Excel, because what I do is I take up this, I take up the closing balance. Yeah, I take up the closing balance, and now what I do, I just copy it. I get the formula, I get the closing balance. Again, if I copy this, and you can do it howsoever you want to wish to do. And last but not the least, this becomes my opening balance, and on that again the formula. If you copy, you get everything. See this stuff. Cool. Are we pretty happy with those stuffs? Easy? Yeah, very easy. God bless me. God bless me. I'm so sorry. Yeah, at a place it's now getting very cold. It's very getting cold. So yeah, I usually sneeze. Yeah, must chalta hai. Okay. Okay, so yeah, we have completed the question second also. Okay, last question for this the third part for this question is about Cavendish. So what have they given? The company has raised the finance by issuing ZCBs. What's that? What's ZCBs? Yeah, do you know what is ZCBs? Zero coupon bonds. Yeah. The company has issued the finance by issuing ZCBs, zero coupon bond. Means zero coupon means in future you don't want to pay any interest only. I'm like, this happens? Yeah, happen. When today if I want to give you something at a reduced price, but at the end I will pay you more redemption. Means today at a reduced price I will give you, and in future I will pay you more. But I will not pay you interest, I will not pay you. So that is known as ZCBs. So what they have given? The company has raised the finance by issuing ZCBs at a par on 1st Jan 2025 with the nominal value of 10,000, and the bonds will be redeemed at a premium of this extra amount. The cost of issue is nothing they have given, it's ignored, and 7% is the effective rate of interest. Very, 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 very easy. I'll just formulate whatever the stuffs is given. First, day 1 it's 10,000. Year 2 redemption they have given 14449. So yeah, if we add it, I get the redemption value also. So yeah, this is the stuff they have given it. Day 1, year end, redemption value. Discounting factor is 7%, and every year interest I will give is 0. And this is the stuff for only 2 years, okay? So yeah, we have to make it this way. Very simple. It will hardly take 1 minute. Just imagine if you know how to do it, what time it takes. Guys, it takes no time. It takes no time. Day 1, ma'am, year 1 and 2. Year 1 and 2. Ma'am, it's 10,000 we have to book it. On that interest of the 7% we take it. Actual payment is 0, ma'am. So my closing liability turns around to be this. Over. Next year's, ma'am, closing becomes the opening again. Interest I have to pay at the rate of 7%, and last I have to make the payments of redemption this much. So if I take up the total, if I take up the formula, it's 0. Clear, everyone? Yeah, very, very, very simple. Very simple. I hope you guys are clear with this. I'll not save it for sure. Can we go ahead? Can we go ahead with the next concept? Oh, wait. Yeah. Now, up next, I want to open the PPT for sure. Now, we need to know what are we going to do it again forward. So, a lot of financial assets, liabilities, we did it. Now. I was having one more question, but then I think questions can be done by yourself also. And important questions, maybe I can do it tomorrow. And yeah, tomorrow we have a concept to be done, that is ratio analysis and some important questions. Yeah? And yeah, without any delay, I will be definitely jumping into my favorite thing, doing the mocks. And we have to do the mocks, we have to clearly do the mocks, in which I cannot just relieve you from doing mocks, because after completing the whole concepts that we are done with, for example the practice, the papers, etc., after revision, after doing the exam kits, if I don't do mocks, it is useless. To clear the first topic and the first agenda is to do as much mocks you can do, because it is any which way is going to boost up your confidence so high that definitely you will be having a surety. No, let's, whatever the question comes, at least I'll be in the position to at least solve that questions. Yeah, I think it's visible, the PPT is visible or not. Yeah, now we have completed a lot of questions. Now that's a position that we have come up with, credit risk. So yeah, you remember I just explained you what was credit risk is something known as impairment. Yeah, impairment means if I feel like okay, bank has given a lot of loans. If bank has given a lot of loans, so for bank, what is that loan? Yeah, if bank has given a loan, let's say bank has given loan So for bank, that loan will be what, guys? It's an asset. It's an financial asset, yeah? Because the bank is going to get things. But what if I say you, the people like Vijay Malia, if they don't pay, ma'am, it's a loss. So what they thought your asset needs to be, if they don't get, it's known as a loss. So that is known as a credit risk. Means the bank will always be at a risky position. What if the customer didn't pay? For example, if I am selling goods on credit to customers, so I'll be having a hell lot of debtors. What if the debtors don't pay me? Ma'am, it's a risk. So prior to many years, जब loss हुआ तब book करेंगे. At the time when it was loss, they used to book. But today they told, please make a presumption, please make an assumption that what are you expecting that the people will not pay? What are your expectations? What are your expectations that you will not receive amount? So we know in the books of accounts also, we require 5% provision of doubtful debts. So what it is, I doubt that this party will not make me payments. So that is known as credit risk. So credit risk refers to the risk of the financial loss which an entity can occur because the next party, the forward party, may be doing a failure to fulfill his contractual obligations. So these type of risks are known as ECLS, expected credit loss. So I need to know what is my maximum estimation of the present value of all the cash flows which I feel like I will not get it. So that's the loss. Then we have credit loss. What's credit loss? If I feel the present value of what the contractual cash flows I want to receive, for example, I think like I'll receive $100, but if I eventually receive $80, ma'am, $20 is my credit loss. Expected means full loss. My lifetime loss means all possible defects. But I have to, like when I'm booking it for a loss, I have to see, like just imagine, if I am the creditor, I am the debtor of one of the company, huh? Or like I am having one debtor, let's see. There are three people. Now just try to understand. Mr. X, Mr. X, Vijay Malia, and some Mr. Y. So what I'll think, as a Mr. X, there is a probability that within 12 months, he may not pay 5% of the debtors amount. Mr. Y will not pay 10%. So I can consider both of them. But if I feel Vijay Malia will never pay me, so I have to consider his lifetime losses, that he may never ever pay me. He may never ever pay me. Getting it? Yeah, that could be the situations. Yeah. So people over here manipulate these things. Yeah, so there are certain questions which are there, fine. So at the time of initial recognition, what I have to do is, students, in initial recognition, I have to imagine whether the risk, whether the people not paying me is significantly deteriorated. No, ma'am, it's normal. Means the condition of the debtor is not like worst. No, it's okay. If it's okay, if no significant deterioration, then you can book for 12 months losses. But if you feel, no ma'am, it's significantly deteriorated, very bad, then you have to book for lifetime expected loss and so on. So there are certain questions from the notes which we can do it. It's very simple. Yeah. This is what just I wanted to touch and come up. Yeah. Now we have the meaning of derivatives. So if I go ahead and explain you what is derivative, which is there in the part. So see, I told you, okay, derivatives is not something which we are going to learn it in the concepts as a whole. Like what is derivative? How do I find derivative? But students, from the exams perspective, we need to know, okay, if there is derivative, what's the meaning of derivative, and in my financial statements, where will I record my derivatives? But it never means I will not explain. I'll explain you for sure. Derivatives means it derives the value. Yeah, it is going to derive the value from the assets, like from some underlying assets. As I told you, if it's milk, the price of milk increases. Relevant to that, based on that, the butter, cheese, price increases. For example, if the price of petrol increases, definitely the sales of bikes and all is going to reduce it, because electronic vehicle sales is going to increase. So everything which gets derived from some underlying asset, so definitely that is known as derivative. So when I go ahead with the derivative, we know people normally trade in derivatives. So when people normally trade in derivatives, what are their intentions? What are their intentions? What do they want to achieve? Yes, we know like there are thousands of people who enter into share market, and none of the people wants to incur any loss, right? So if people want to enter into a market which is basically a derivative type of market, Definitely everybody wants gains. So whenever it's the word, we get a derivative, and we know people wants any type of gains or losses. If the people are interested, it's always understood that if it's gain or loss, their intentions are to earn gain and loss. So anything which appears needs to be put in P&L account. If it's a loss, I'll book like this: P&L account debit to derivative financial liability. If it's a profit, it's like derivative financial asset account debit to P&L. Why is it so? Then what is the concept of derivative for the first? So I told you, derivative means if any of the value changes, like anything, which derives the value from the underlying asset. For example, over here if we are betting, you don't need to put money, even I don't need to put money. For example, I told, like today now, I feel like the X company's share price will grow. Today it's 1000, so I told, okay, no, it is going to grow beyond 1000. You don't know it's going to be down lesser than 1000. If actually the prices turns around to be 994, so you are going to win. So I'll pay you the difference amount, only that much. For example, try to understand it. For example, if we have made a bet, we have betted on it, like what I told, the price of the share is going to, I told it's going to go up. You told, okay, it's going to go down. Okay, and today let's say the price of the share is $1,000 per share. Actually by the end of the day, if it went $1050, who is going to win? I'll win now. If I win, it's my financial asset. So will I get 1050? No, you will also not put 1050. You will also not put 1000. I'll also not put 1000. I'll only get how much, guys? I'll only get the difference. So this becomes my derivative financial asset 50, and that becomes your derivative financial liability, because now you need to pay me the difference of 50. Getting it? So yeah, initially now we don't have to invest something. Like, okay, if I want to invest some margin, it will be better. But when we go ahead with the definition, it clearly says that it is going to derive the value from underlying asset. Yeah, derive the value from any asset. Plus initially now, like you don't have to invest more or like keep more. No, maybe margin money will be fine. Okay. Plus the settlement is going to happen in the future. For example, today we entered into another example I'll give you. For example, I told Virat Kohli, yeah, he's a very good cricketer, obviously. So I told Virat Kohli will score more than 80, and you told lesser than 80. Actually if he scores, let's say 102, so who is going to win? I am going to win by how much? 22. So it will be a derivative financial asset for me, and this will be 22 will be for you guys a derivative financial liability. Getting it? Yes or no? I'm trying to like take it up in the very easy format. Okay, so settlement in the future. So yeah, with that overview, if we read the question, we read the theory. Derivative financial means the derivatives is a financial instrument which has the characteristics like it can derive or change its value from anything in the market. Means it can be affected by the interest rate, commodity price, security price, any rating. That is known as calling it is an underlying asset. So to enter into derivative, do I need a lot of money? No, ma'am. A little or no initial investment will also work well, and the settlement is made at the future date. So this is the definition of derivatives. So ma'am, I know people will say, okay ma'am, we have not heard derivatives so much. Instead of that, we have heard 2-3 words other. Yeah. Derivatives is not something which we have heard. Ma'am, we have heard something about forwards, yes, futures, options, and swaps. So when I say something about, like just giving you an example of forward contract. So what's forward contract? For example, if I'm sitting in India and if I want to have some import from some foreign country. So what is my biggest fear? For example, if I want to import, okay, if I want to import from US, let's say 20 bags. today at the rate of $50 per bag. Or forget about 20 bags. Right now, we'll take only one bag. Only one bag. At the rate of $50 per bag. Yeah. Today, let's say today, rupee per dollar, rate of interest is going on, let's say 94. So if I make the payment today itself, what will I make the payment in my rupees? Ma'am, 94 into 50 you can pay, right? Ma'am, so my expenditure will be 4700. That is cool. But I told you, students, I don't have money today. So I just told, okay, please give me on credit. He said, okay, Baba, we give you credit for 3 months. Oh my God. If he gives me a credit of 3 months, do I know what will be the rupee per dollar after 3 months? So I'll be always having tension. If the rupee per dollar increased, so I may end up paying more. Correct? I may end up paying more. For example, if I say rupee per dollar, for example, if it is 98. Oh my God, ma'am, if it's 98 into 50, so I have to pay 4900. Ma'am, it's a loss. So to avoid that thing, so to be like safer than that, what I can do is, guys, I can enter into a forward contract. So what we do, guys, we enter into a forward contract. We come up with bank today itself. I told the bank, see bank, I have to pay after 3 months. I don't know like what will be the price. Can you please give me a surety? Acha baba, this much only price I have to pay. So yeah, the bank will come up and the bank will say, okay baba, if you want to like settle somewhere, if you want to feel like, okay, you want to come up ahead, we can settle a price. We can come up with the forward contract with you. Yes, guys. And they come up a forward contract and they will say, okay, whatever the price may be after 3 months, it's okay. You have to pay rupee per dollar 95. So I'll be at least secure. That maximum I have to pay 95 at the rate of 50. So maximum my liability will be 4750 rupees. Cool. This is what I'm secured, guys. This is what I'm secured because I have entered into a forward contract with the bank. At least I have to pay this much only. What if actually after 3 months, actually what happened? Actually, rupee per dollar turned around to be 98. Oh my God, 98 into 50. So I'll feel, oh my God, 4900. Will you be happy or not? Actually the prices are so much. But you'll be very happy because now you have to only pay this much. So now it's a gain. Gain of how much, guys? Gain of 4750 minus this. So it's a gain of rupee 150. Because now you will be secured. Now you are secured that whatever it is the price, you have to pay only 4750. Yeah? Because you have entered into a contract. I will be not at all concerned with whatever the fair value will be relevant on the last date. Okay. What if I say you the change actually after 3 months the price turned around to be rupee per dollar 90. Oh my God. Means if I would have not entered into a contract, so maybe 90 into 50 per bag, I would have got 4500. Like I would have paid only 4500. But now if I have already entered into a contract, ma'am, it's a loss for me. Loss of how much bag? It's 250. It's okay. Yes. So this is a stuff of forward things. So over here, this is the first concept of forward contract. Means you need to know, you have to came up with a situation that like if you want to settle something in the future, but if you're very much concerned about the price, so today you want some understanding like what should be my maximum amount, which should I pay. So yeah, we can obviously enter with the bank any payments like anything. So yeah, that is known as basically the forward contract. So just understand, just one liner. The holder of the forward contract is obliged, means I have an obligation, like whatever I have entered into to either buy or sell at a price which is fixed, like rupee per dollar, which I fixed with the bank. Yeah, I have to make the payments of the asset at a specified date. I have to make the payment. And then actually whatever is the situation, I have to compare it and book whatever the gains and losses are. Easy? That is something the forward contracts. Same it is for future contracts also. But in this, futures are something which is the government, like it's been decided and we cannot cater it in whatever I want. Like I'll tell forward contract, okay, I want only one bag, I want to buy only one bag. I can do that. But if it's future, the lot's size and the quantity, it's everything is being fixed. But the concepts are same over here. So future contract is also obliging the holder to buy and sell at a standard quantity. So I cannot what I can say, I cannot cut it, like I cannot just tailor my thing. I just cannot tailor it. I just cannot tailor it. Like, okay, I want only 10 units. No, no, no. You have to buy it at a specific price and specific rate. It is very similar to the forward contracts. The difference is only we need to have a standard terms. Okay, so that is the future contracts. Up next, we have two things: swaps and the options. Swaps means, for example, we don't have so much things in our examination from this point, so I'm not taking up so long time to explain you guys. But it's something like two parties are agreeing. Like if I want, when I go to the bank, my bank offers me, and if I want to take a loan, they offer me two things. They offer me interest. Yeah, they tell me you have to pay interest. So they give me two options: whether I want to pay a fixed interest or whether I want to pay the floating interest. In India, we have MIBOR, MIBOR, MIBOR. Plus in London, it's like London interest banking rate. Okay, so LIBOR plus some 2%. So this LIBOR is something which is floating, which is not fixed. So now I have to understand whether I want to take fixed or whether I want to take the LIBOR rate, right? Fixed or floating. So yeah, if I want to take fixed interest, yeah, I can take fixed interest. But somebody else wants to take floating, they can take floating. But what happens in the swaps? The floating person will be given fixed and I will be given floating, and yeah, in such a way that both of them gets benefit. Okay, so that is certain swaps. So two parties agrees to exchange the periodic payments at a specific interval. For example, in the interest swaps, the parties may exchange the floating and the fixed rate calculated by some notional principal amount. And the last but not the least and the easiest concept is options, which everybody would have heard. Everywhere now we have heard the word obligation, but when it is option transfers into rights. Like it is my right whether I want to exercise the option, whether I want to not exercise the option. So you'll be seeing now what it is. Yeah, for that I'll just give you one question, like we'll understand it. So when I talk to you about guys options, everybody has heard the word call and put options, right? We have C plus, we have C minus, we have P plus, we have P minus. So when it is options, the holder of that thing is having the option, like whether I want to go ahead or I don't want to purchase it. For example, I told you, you are having a purchase option at the rate of $210, but you have to pay a premium of, let's say, $5. Okay. For example, you have to purchase one thing at the rate of $210, and that is sure you have to purchase. You have to purchase at 210. For example, in the market, the rates, the prices turns around to be 220, 240, 190, 180. Tell me, will you exercise your option or will you lapse your option? Whatever you do, you have to make the premium. You have to pay the premium always. Hey, what's that? What's that? Means, if I told you, Baba, you have to purchase one thing at 210. Like, if you have to purchase, if you want to purchase, you purchase at 210. And you have to, anyways, pay the premium of 5 also. So, now, if I'm having an option to purchase at 210, for example, and in the market, if the rates are 220, will you be happy to purchase at 210? Yes. Yes. If you purchase from market, you have to pay 220. It's not better to purchase at 210. Yes, ma'am. So yes, ma'am, I will exercise the option and I will purchase at 210. So what is the gain I'm getting? So if I purchase at 210, yeah, can I not sell in the market at 220? Ma'am, yes, ma'am, I'm getting a gain. Gain of how much? Gain of 10. But whatever it is, guys, you have to pay a premium of 5. It's a minimum payment. So my net gain turns around to be 5. Yes, getting it? If you have to purchase at 210 and in the market if it is 240, yes ma'am, I will definitely exercise. Why? If I purchase at 210, if I sell it at 240, I get ma'am 30 ka gain. But obviously ma'am, minus 5 you have to pay. So your net gain will be 25. Yes. But what if I tell you, you have to purchase at 210, but in the market it is being sold at 190, like you can find in the market at 190. Are you mad to purchase at 210? Ma'am, I will lapse the option. I will not purchase. So I will have no losses. No losses because I don't want to incur. But yeah, maximum premium ka to loss you have to pay, because premium to any which ways you have to pay only. If it's 180 also, I will lapse it. And yeah, I will not pay the premium. Like I will not have any losses, but actually I have to pay the premium. So that is just a general concept which we need to learn it about the calls and puts. So what it says, like it's not compulsory. It's not compulsory, guys. You have the option. If you want to, you can purchase. Okay. Over here, like market rate means over here, you get a value at this much you have to purchase or you have to sell. If market fluctuates, then if I purchase at this price and if I sell it in the market at that price, am I getting any benefits? If yes, only then I can go ahead, otherwise I'll not go ahead. So these are the concepts of options. So this gives the holder the right but not the obligation to buy and sell or whatever future dates. So yes students, with these we have completed some derivative portion also, derivative measurements. So initially you will book at a fair value. Whatever losses and profits you get it, you will put directly to P&L account, because derivatives is always for getting profit. Yeah, derivatives always recognized in the P&L account only. So yes students, with these we have completed a lot of questions, a lot of concepts, a lot of concepts of financial instruments. Like I'm so happy that I completed so much questions, so much concepts in very less times. Up next now students, we have a small concept of hedging, maybe the hedging concept, and the ratio analysis will be doing it in the upcoming class, that is basically tomorrow. So yeah students, so we have covered today IS 19. If you guys have any doubts, please do message me. Okay, please do message me. And yeah, for this chapter also, if you have any query, you can just message me on Telegram, on Instagram, on the chats also. So I hope we could manage it doing it very easily. Thank you students. See you tomorrow. Bye bye.